November last year, we were talking about some potential changes to the code. The code was released in the middle of January 2025, but it is the version of December 24. That's when it was agreed. So now we can confirm the changes, and it is the expectation of the Global FX Committee and of its members, and we'll talk a little bit about that, all market participants do re-sign or review the code, implementing the procedures, the changes that have happened in the space of 12 months. So we are looking forward to seeing all of you renewing your statements of commitment before January, but of course this is just an expectation, as you all know, in terms of the global code. So we will have a session today. Some of the things, the changes at the code were not that much in terms of size of content. Out of the 55 principles, we had 5 principles updated. There was some other changes around the code. We'll cover them all today. So you will see, and then we'll receive, of course, the presentation as last year. So you will see that some of the content hasn't really changed. So we're just going to go through that and talk a little bit about not only with the implementation of the code and also with your recertification in the next coming months. We do have quite a lot of exercises that will follow, and I will ask the participation of all of you for those exercises. So I'll go around the tables to ask what is your opinion in terms of the exercise. The idea there is that those exercises are not there on a random case. They are there for a purpose, because they are there for us to think a little bit about the practical implementation. Some of them are very simple. Some of them are not that simple. So it is really for creating a debate so we can look into some of the practical aspects of the code. In terms of logistics, so again, I'll ask you to hang in there because we're going to do a full morning until roughly 12:15, 12:30. Then we'll do a 1-hour break. And I kindly ask you, let's really keep it to 1 hour. Yesterday we overran, and this is why we had to leave a little bit late yesterday. But it is Friday, thank God it's Friday, and we all have a big party tomorrow night, so I'm sure that you want to go early today. So let's try to keep the lunch within 1 hour, and then we can leave at the scheduled time of 4:30. So please hang in, and we'll have a mini break at the afternoon as well. So let's go for that. Nothing changed in terms of ACI, except that we actually accepted a new association this year. So this year, Oman joined the ACI community in our council meeting in Congress that we held in Paris for the 70th anniversary of ACI. But we're keeping our core values, the same core values, and we keep promoting as well, of course, our members, and of course here represented by the members of SLFA, which is an affiliated association to HCI. You all know that. But of course also the part of education, ethical conduct, and it is, both of them are connected here. Actually, the 3 of them are connected here because we are talking about the code through a workshop that will help the members of SLFA. And I hope will help the members there as well from the rest of the Asian associations that are affiliated to ACI through the broadcast. So we'll just go. We have a packed program. Again, we'll cover the 6 leading principles of the code. We'll see the changes that have been applied to some of those principles. Out of the 55, as I mentioned, 5. But we'll also go to some key topics as well that are being discussed currently in the market, like data transparency, delegated execution, which actually was a change in the code. We'll talk a little bit about pre-hedging because it is in the code, of course, but there was a recent report from IOSCO following a consultation period about pre-hedging. We'll also talk about settlement risk. Unfortunately, it's growing, and we need to see what we can do there in order to control it. And then we'll go just a little bit into the part of the exam and give you a few tips for those of you that have taken the exam already. You know those tips. We'll just focus a little bit, but it will be helpful for the others. Okay, so let's go for that. Just a normal introduction. Nothing changed in here. Continues to be the largest financial market in the world. And actually, we now have the figures from the BIS triennial survey Normally the figures are always calculated taking into account a particular day in April. Of course, in April this year we had Liberation Day, so we did have a lot of volatility in the market, but in terms of the daily turnover of FX, it moved from 7.5 trillion to 9.6 trillion comparing 2022 to 2025. That is a massive, massive growth in the volume of the FX market. So it is growing, and of course, if it was already the largest financial market in the world, oh, you cannot see? Sorry. Sorry. Do you want to move in here, or because of the camera? Sorry. Ah, okay, okay. Can I stay? Shall I? Where shall I stay? The important thing are the slides, right? Okay. And then just the voice, yeah. Does it? I don't look myself in the mirror more than 1 second, so it doesn't need to, no one needs to see me. Okay? Yeah. Okay. As I was just saying, so a big jump in the volume of the FX, the daily volume of the FX market. Just a small change there. We had about, in the 2022, about 95% was in vanilla products, but now it's only 93, but not major change. The biggest change was actually on swaps. Swaps were actually representing 51% of the volume back in 2022, and it has fallen to about 43%. So it's a big jump on in this case, a big fall on swaps. And actually, just on this timely issue, but not only on that, if you haven't received yet, I'll ask SLFA to send you a reminder. We will be holding a webinar on FX swaps to talk about the particularity of this product. It's still, as you can see there, in terms of percentage, still the most traded instrument in the FX market. And next Wednesday at, let me just make the calculations, at 1 o'clock Colombo time, I think it's 1 o'clock Colombo time, we will have a webinar on FX swaps. So please feel free to join that. Okay, so very, very simple market, but also very complex market as well. In some currency pairs, we do not have a unique price all over the world. It's very fragmented because everyone can trade FX, from the retail client, from the personal into a central bank, or into a large corporate, into a large bank. So we do have quite a lot of activity in the FX, so it makes it a little bit complex. And of course, it's 24/7, 365, but of course, in various times of the day, naturally, in the night, there's very less liquidity than in the normal times when, for instance, Asia, Europe, and are working, and of course, also when Europe and the Americas are working in terms of the time zones. But so it's a complex market. What we do feel in this market is that, unfortunately, some of the issues continue to occur in terms of the rigging, in terms of manipulation. We don't have a lot of fixings around the world in terms of the traditional way that the fixing were done, indicative levels. Most of the fixing, because of the problems that happened over the last few years, not just in the foreign exchange market, but also in the interest rate market, the commodities market, a lot of those fixings are moving to transactional fixings, so they report the weighted average of the transaction executed at the fixing in terms of the amounts, but most important in terms of the price, because we're talking about fixing a price. But there have been some cases still even on indicative prices where there is kind of a collusion to agree a rate, which normally it is to penalize the client. Normally that is the stance. So the code actually was brought up after all this situation, not only again for the FX market. Similarly, it happened to perform the ethical and professional standards that are expected from the industry. But some unfortunately very few, but their impact is actually very huge. A few of them do not do that. So that's why the code and similar initiatives have been brought in order to correct this. The fixing is just one. And it's really, some of these practices were not really done with the intention to penalize the market. Some of these practices were actually just normal. But what is normal 10, 15 years ago, it's not really normal today, particularly as well with the development of technology, on how we're really dependent on technology to perform our activities in the FX market. So in some of those instances, it was just a common standard. What I did in the market when I was trading 15 years ago, 20 years ago, when I was selling products to clients, I can do the same now, but not in the same manner, because some of the things were just normal. I was taught that some of the things were just normal. We need to challenge some of those situations, and particularly about the judgment. So that's why sometimes even the fixing, this is an old news. This is the fixing. This was something that was even known, I mean, within the regulator. So this is something that we need again to challenge that, because it's not really working in terms of helping us with promoting the good market practices that we want. Anyway, then the start of the FX Supercode, about 2014, 2015, the initiative started. We started to have meetings of the persons then that work at the development of the FX Supercode. We were on those meetings since the beginning, probably because, of course, we have a long history of producing codes of conduct. So ACI was the first to launch a global code of conduct initially for the FX market. Then it started to cover other asset classes back in 1975. And because we got involved in the work of the Global FX Committee, then we decided to publish the last version of that in 2015, and we will never publish it again, because from then on, and given that this model code actually served as a very good guide for the initiative that then led to the launch of the FX Supercode in 2017, we decided to stop the publication of the model code, and we decided from then on to promote and fully support the FX Supercode and the other codes that originated from the base of the FX Supercode, like the Global Precious Metals Code, and like the UK Money Markets Code, and more recently, the GDF Global Crypto Asset Standards. All of these three, they follow the base of the FX Supercode, and they receive the full support of ACI because the base is very good. And we feel that for the other asset classes, what they've done, the industry, the Bank of England did for the UK Money Markets Code, the LBMA did for the precious metals, and the Global Digital Finance did for the crypto asset standard. So we believe that those codes really, really help the industry, regardless of the asset class that it relates to. But coming back to the FX Supercode, so we were there in the beginning, and as you can see there on the report from the Global FX Committee, our model code was routinely sourced as a guide for that initiative. But we keep being there, so we do have quite a lot of cooperation with the Global FX Committee on an ongoing basis, not only because we have members and very active members in some of the working groups of the Global Foreign Exchange Committee, but we also have regular participation in their meetings. I was in their meeting, the last meeting in Singapore in the beginning of July. They will have a new meeting in about 2 weeks, so that will be remote. But we also participate in various local FX committees that have or are part of the Global FX Committee. I'm an observer through ACI to the Nordic countries FX Committee, and normally we do have, of course, the regular interactions with them as well, and we publish feedback to the public consultation. So the idea is that we and other trade associations, of course, we keep helping to promote, and to develop the code, because it's 8.5 years old, but it's still really, really just a child. So the code will be here forever, and it improves as the market goes along. So again, just a statement to the support of the FX Supercode. So coming back to the nature of the code continues to be a code, of course, built by the industry, as it was in the beginning, serving the industry, and continues to be now. When we work on the improvement of the code, you do see there it's not just the central banks, it's not just the sell side, the banks, no, the buy side is there, trade associations are there, infrastructure providers are there. So the whole industry, various sectors of the industry, work on the development of the code to go and serve all the market participants of the industry. And when we go and I talk about the code, I wanted to mention a curious fact. When the code was launched on 25th of May 2017 in London, a lot of persons, even before that launch, were branding it as Global Code of Conduct. Especially, and I talk normally to members in the UK and even some of them outside UK, but mostly in the UK, they still refer to the code as Global Code of Conduct. That is not correct. The code is branded as FX Code. The code is branded as FX Code because it's not only about personal conduct. It's not only about what we do as individuals on a daily basis, which is related to our ethical and professional conduct. The code, and particularly as I mentioned before, because of the development of technology, we do have quite a lot of measures and procedures and process and recommendations that the code makes in terms of what we should put in place for us to have a responsible involvement in the FX market. So how can we implement systems to control our activities? How can we implement systems to monitor? How can we make automatic reviews of those systems? Of course, there's a human interaction in programming, in drafting norms and procedures and processes, but it's not everything that we just, or it's not only what we do as individuals when we are trading or when we are selling. It's much more than that. For those of you that have seen the code, have done the exam, have been in the workshops that we've delivered here, you remember the risk management and compliance, where it talks about the frameworks for risk management, compliance, and audit, has 18 principles out of the 55. That's slightly over 30% of the code is on principles related to risk management, compliance, and a little bit of the audit. So it's not just related to our personal involvement in the market or with clients or with brokers or with other banks. No, it's much more than that. So it's not really a code of just ethical conduct. It is a code that promotes good market practices for all countries around the world. So coming back to the December 24, just some curiosities there in terms of the translation. So several translations already. You can see that there are two Spanish versions. One has been translated by the Bank of Spain. The other has been translated by the Central Bank of Mexico. So there are two translations, and I'm sure that there will be other translations coming up in the future. So it's really still the same. It's a code that helps to restore trust in the FX market after all the scandals. And again, the scandals were not just on the FX market. It is a code that promotes a fair and appropriately transparent FX market. And it's also a code that tries to replace our other existing global codes by one global code of good market practice. The idea of the code being voluntary is exactly to support this. It is a voluntary code because, of course, none of the members of the Global FX Committee have the power to implement a local code, for instance, in a jurisdiction all over the world. No, because that's the responsibility of the regulators in that specific jurisdiction. So the code has principles based. It's a voluntary nature, but the way that you apply it in every market, it's really up to you. It's really up to the market participants to understand how to apply it. We have seen examples of the code being translated into local regulation. We know three examples in Africa: Kenya, Uganda, and Tanzania. They have adopted the code. They slightly changed some of the principles. That code doesn't have 55 principles. It has 52. There's a particular reason for that, because the code only applies, and in these three countries it's mandatory, for banks, for the licensed commercial banks which are registered with the central bank. So the code, the principles on voice broker for these countries, they're not applicable. The principle about prime broker, they're not applicable. So they adopted the code because the good market practices are there and they can serve in every country. The code has a voluntary nature, and this is what we need to understand in terms of the code. But in some countries, they have taken the code, they say, let's adapt it to our reality and let's go and implement it. I'll tell you another curiosity on that. In some of those codes, when we go into the 3 first principles on ethics, there's a requirement there that market participants, us as individuals, from front office, back office, risk management, compliance, everyone that is individual market participant, we'll do an exercise shortly on that, needs to really to perform the duties, the FX code recommends that needs to perform the duties with experience, with knowledge, with skill. So in some of those countries, our exams, like the ACI dealing certificate or the ACI operation certificate for some of you that have taken those exams, they are actually mandatory if you need to sit on that particular environment or that particular area in those countries. So because it is already mandatory, it was brought into the code. So the global code, of course, and you remember for the ones that have seen have been in workshops with me before, the code doesn't talk about ISDA. The code doesn't talk about the collateral annex on the ISDA, because it's not, if it does, it restricts to the application of the countries that have legal enforceability of the ISDA. Not every country in the world has legal enforceability of the ISDA. The same with SWIFT. SWIFT is not mentioned in the code, but what SWIFT means, it's mentioned in the code, because some market participants do not use SWIFT. Particularly the same. So the Global FX Committee would not go and say, as a voluntary net, that everyone needs to take the good dealing certificate. But it's not mandatory all over the world. But in those countries it is, and they have adopted. So they have just adopted the good market practice of the code. They tweaked it a little bit because of their own particularities. But the most important thing is, any jurisdiction can do what they want with the code. The good market practice is in there. At a global code, it is a voluntary nature, but then again, every regulator in each country has the power to do what they can with the good market practice, because they are there. So you know this, we cover this, just a sketch covering the main parts of the principles. No change there, no change in the leading principles, no change in the application, no change in the objectives, no change in who to apply, and of course the development. We also talked a little bit there on how it was developed. So no change there. I'll just go through. Just an update on the calendar. In orange or yellow, the 3 main updates of the code. Of course, the launch, then the July 21. As we all know, it was supposed to be in 2020, but because of the pandemic, that was actually postponed for July 21. We had the first major change of the code, but even though that major change was not that major, but we'll cover that in a few minutes. 11 principles out of the 55, and now 5 principles out of the 55, with the curiosity that 3 of those 5 principles were already updated in July 21. So we'll cover those changes as well. So it will continue. The idea from the Global FX Committee, the estimate is that we will release a new version, an updated version of the code every 3 years. We didn't do that in 2020 because of the pandemic. So most likely when we get to the end of 2027, we might have a new version of the code. But there is no doubt that the code now, even 1 year after it was launched, and even because only 5 principles were updated, the code is very much considered fit for purpose. Didn't have a comprehensive review. It's really just a target review because of some of the issues that we'll cover today. So very much fit for purpose, but we don't know what the way that the market would develop. And this is why the Global FX Committee has regular meetings to discuss not potential changes. No, they haven't discussed that yet. It might happen in 2 weeks' time, but we don't know yet. We're waiting for the press release. But there will be some time in which they will, coming into 2027, they will start discussing whether there are merits for reviewing the text and some of the principles of the code, but not only that, because we have the annexes, we have some other templates as well, but we'll see what happen in 2024, and then it will help us to get a little bit into that. So no change there, of course. Ethics 3, just a small portion of the code, but of course it forms the base, that particularly for our personal involvement. The part of the governance really forms the base for all the structure, all the framework that we should have at every market participants to help us to put in place the good market practices, be it in terms of our personal activity every day, or also in terms of all the processes, the procedures that we are installed at our firm. So just the base on that from those two aspects. Then we go to the execution, normally labeled as valid only for the sell side. That is not true, and we will, over the course of today, talk a little bit of situations where the buy side, be a corporate, be a fund, an asset manager, they definitely need to adhere to the code, because there are so many things that they are responsible for, and they can only do that if they want to promote, of course, the integrity, the fairness, and the transparency of the market. They can only do that by adhering to the code. So we will cover a few mentions during the course of today that the buy side really needs to adhere to the code, because that will benefit everyone. Then we go into the information sharing, only 5 principles, but really relates to the way that we talk, the what can we share, and also as well, where can we share? Can we share it by phone, record it? Can we share it on WhatsApp? So we'll cover a lot of that. Then we go into in terms of number of principles, the biggest of the 2 parts of the code, as I mentioned to you, risk management and compliance with 18 principles, talks about those frameworks that I alluded to earlier, risk management, compliance, and audit/review, and also covers the 7 key risk types that they are expressed in the FX code. And finally, the part about post-trade confirmation, settlement, account reconciliation, and netting as well on that with 14 principles. So no major changes in the structure of the code, just in some of the principles that I mentioned to you. Now, we talked about this debate continues, and I mentioned to you 3 examples in where the lack of a better regulation for FX market, foreign exchange market, 3 countries pick up the code and adopted it as their own regulation. So again, the good market practices are there. They serve potentially every country in the world. The way that every country in the world wants to apply the FX code, it's up to the regulators and to the local professional markets, market participants community in that country, the way to adopt the code. I mentioned 3 examples to you. The vast majority of the countries, they adopt the code in a voluntary nature. But for instance, some central banks, even before the code was launched, were saying that, okay, it's not mandatory, it's voluntary. But the central banks have stated clearly, and not only stated because they really stick to what they affirm, we are only going to deal, so the code is voluntary, but we are only going to trade FX with counterparties that have adhered to the code. So it's not mandatory, but if you are a bank in a country and you want to continue trading FX with the central bank, when you hear this kind of statement, what do? If you are a bank in the country and you don't trade FX with the central bank, so there's a strong encouragement, a strong incentive to join and to adhere to the FX code. So again, one way or another, it is really a good adherence. Adhering to the code is good to the market. You can do it, of course, voluntarily, or you can do it mandatory, as I mentioned. There are other examples, probably not so much in terms of adopting the whole code minus 3 principles like those 3 countries, but other examples where some of the portions of the code were adopted and were translated into local regulation, local or regional. But the code there is really to help out the market, particularly to reduce or potentially eliminate situations where we can see illicit activities, malpractices. I mentioned to you market abuse. I mentioned to you mis-selling. I mentioned to you fraud, manipulation. So the idea of the code is to promote a responsible increase in terms or enhancement in terms of our activities in the FX market. Again, not just by us, by individuals, but through the involvement of our firms, and we really need to go on that. We firmly believe that education plays a key part on that, and at the end, I think we mentioned in previous workshops, but we do have some results, not just ACI mentioning that, but we do have some results of the surveys that have been done over the last few years that show exactly that. Education is a key step to monitor. So thank you again to the Sri Lanka Forex Association, to all of you, and to yesterday's members as well, for adhering to that objective, because that will help us as well to adhere to the code and implement it. The whole idea, as I mentioned to you, it might be a dream, but it is, someone once said, I have a dream. Probably this is my dream. I do want to believe that everyone is already putting the highest standards of ethical and professional behavior, as I know that you all do, in a natural way. When you go into your offices every day, or the way that you set up your systems, your controls, your procedures, you already have that in the back of your mind. So but unfortunately, as I mentioned before, some persons do not do that. So it is important that we really try to promote as much as we can that should be natural. That behavior should really be natural, because it will help us to get into the market and to make the market better. In the end, if the market gets better, if the market gets more transparent, more fair, and has more integrity, it will help us all, and it will bring more players to the market, not only from the sell side, but also from the buy side. So it's important that we all have that common objective, but that is a natural objective, just by being responsible. And we'll cover that a little bit later, that a lot of the areas of implementation of the code in your daily roles might be a little bit gray, and that's fine. Let's apply judgment. And there's a way that I can suggest you to apply judgment. If there is anything in doubt, and again, because you are all promoting the ethical and professional standards, if there is something that is doubtful, because you already have that nature, don't do it. If something is in doubt, because you already promote that good culture, if something really looks fishy, don't do it. It's probably the best way. Don't do it. That's the judgment that we need to apply. And we'll cover a few of those examples in the exercises. Okay, so really the code is, as I mentioned, helps potentially to be applied in every jurisdiction. It's really a code easy to adopt and incorporate by all market participants. So there's quite a lot of statements that say that we really need widespread adoption, because it would be good, even though it has a voluntary nature, it would be good for the FX market that all market participants embrace, adopt, and adhere to the code. But this needs to be on an ongoing basis. That's why I mentioned to you the code is still a child, and even though if we can say that it only changes every 3 years, and I'm saying only because when we compare to financial markets, it's changing every time. It's changing very rapidly. Things are changing in the FX market very rapidly. But the code, again, even though it is something that only changes, if I can brand it only between commas, every 3 years, is still very much, as we saw and we mentioned when we go and see the change, still very much fit for purpose. So the code is there. And the code is easier to adopt than some regulations. And some regulations, as we all know, they take more time. So it's not only 3 years. But anyway, there's a lot of things that can happen because the code has a voluntary nature in order to adopt, to help market participants. And one very important point that we'll cover in a few minutes is that the code complements applicable law. Regulations, all market participants that are subject to a particular regulation, there's no way you have to apply to it, right? Because you open your doors, you're doing business, you are subject to the regulations. They are mandatory. The code helps some regulations. So we can help the regulation to be applied. And sometimes you can even give a little bit more clarity. But we'll cover that, and that's the nature of the code. So again, the code has voluntary nature and adherence. does not have the intention to supersede nor replace the local regional laws and regulations, does not represent the judgment, nor it is intended to buy the discretion of a regulator or supervisor, and does not provide the legal defense to a violation of laws and or regulations. So it is really a complement, but in some situations it might help to clarify some of the practices, and it might help to reinforce the market. This is why, as I mentioned to you, we talk about those 3 countries, but in some other countries, some of the measures of the code have been applied as local regulation because it helps and it complements that local regulation. That is the intention of the code. So it does not replace applicable law. Some examples, we mentioned this already last year, some examples. For instance, historical rate rollovers in some countries is still allowed to do that. The code doesn't say that it's not allowed. What the code says, it's not really recommended, because when we're talking about historical rate, we are saying that we need to use the rate from the past. The code suggests that we should always do any FX transaction, an anticipation or an extension of the maturity date, of the value date, always at the rate of today. So there are some techniques that you can do that, because of course, if you roll over a position, and let's talk about a position of forward, an outright forward from a client, and the client bought for, let's say, bought 2 months ago for 3 months maturity. So we will mature in 1 month. If the client comes today and say, I don't have the dollars in 1 month, can we extend it for another month? That's not a problem. But in order to do that, we cannot use the rate. We should not, again, it's not, we cannot because the code is voluntary in nature. It's not a good market practice to use it, that extension, to use the rate of 2 months ago. We should really do a settlement, positive or negative, at the rate of today, and with the rate of today to do a new forward for 2 months' time to reflect the customer that at that time then he will have the dollars. So just a way to do that. So it's not saying that rate rollovers are not recommended. Rate rollovers are okay, but when they come into picking up historical rates, they're not really recommended, because that can create a high credit risk, credit limits that are really, really higher, and can create credit consumption, and of course then it will be subject to a capital charge, because we are extending a position that might not be, for instance, if it is negative to the client, we are just extending the problem, and of course creating more credit risk, and because of that we need to put more capital to control that credit risk. So again, there's been some situations in the past where this really provoked or caused a big issue in some markets. So it's not a recommended good market practice using historical rates for rollovers. The code has some clear guidance on that. For instance, the markup, disclosure of markup, or to the margins that we supply to customers. In some countries it's not applicable, but we do know that in some countries they have already picked up the part of the markup, because we'll cover that in Principle 14. There's a need to have policies as well, agree on those policies with the client, and those policies really need to detail all the characteristics of the markup, and they have been applied in some jurisdictions where there was not that requirement. So what is the benefit here? Transparency. By the fact that we are applying a markup policy and we are agreeing with the client what that markup is or what that margin is, we are bringing transparency to the market. The client will have detailed information of what we're going to apply on that particular transaction. But of course, the market is not always plain sailing. As we know, the market is very volatile. The markup policy also can have that kind of exception. How do we apply markup policy that if we put 10 pips, but the market is very volatile, and maybe we're not able to put 10 pips. So the markup policy can have details that you might agree an exception to the markup policy, but you need to agree with the client. The whole idea here is to bring transparency, as I mentioned, and it has been applied by some jurisdictions that didn't have that. They picked up the part of the code, particularly on Principle 14, and also as well the part about best execution. So best execution is throughout the throughout the code in all FX products, because the code covers all FX products. But for instance, under the Marketing Financial Instruments Directive in Europe, it doesn't cover spot FX, because the Marketing Financial Instruments Directive in European Union only covers financial instruments, and spot FX is not considered as a financial instrument. So that was an idea, and we'll come back on that. We mentioned that on a previous workshop, but just to tell you a little bit on this, a little bit more detail. Financial instruments in European Union normally are forwards, swaps, options, not only for FX, of course, bonds as well, but spot FX is not a financial instrument. So, but the FX code has the best execution policies that we need to supply clients with the best execution possible at the moment that the client gives an order. So there was a suggestion that we would have spot FX labeled one way or another, in an indirect way, as a financial instrument to compare with other instruments that have mark-to-markets, like forward, like swaps, like options, like other types of the interest rate swaps. So there was a suggestion to include in there, not through directly into this directive, but into another regulation in Europe. And so just to show you a little bit that in Europe there's the market abuse regulation, which again contains this kind of prohibitions. And there was a suggestion that spot FX could be labeled or could be integrating the market abuse regulation. But in order to do that, because market abuse regulation only covers financial instruments, so spot FX would have to be labeled as a financial instrument. So the securities regulator in Europe, ESMA, published a consultation and requested feedback from the industry, or what the industry would think about this. This is still a little bit. It was even before the pandemic. Sorry, we just get So this was something in 2019. We had a framework at that time because, again, as I mentioned to you before, we support and the FX Global Code and the Global Code as best execution for all FX products, including FX spot. And that time the code was about 2.5 years old, so we thought that we needed a little bit more time. So on this framework, we actually provided a response to ESMA, which particularly on this possible inclusion of spot FX contracts in this regulation. And remind you what I just mentioned a few minutes ago, by having, if this was allowed, spot FX would need to be labeled as financial instrument. It's not just a label. There's a lot of caveats behind that label, and this is why it normally applies to products, for instance, to products with mark-to-market. Products normally where you have the dates to a tenor forward than spot. So we published a response, and basically what we said, it would weaken the intentions of the FX code, it would cause fragmentation, impact liquidity, bring considerable cost to market participants, and it will bring more challenges to the FX market. Normally, because all financial instruments in Europe have a transactional reporting which is quite substantial, and of course the best execution that is already covered by the code. So we believe that at that time it would not be beneficial for the market for these circumstances to integrate spot FX within the market abuse regulation, and then of course as a normal consequence to label it as a financial instrument. And because it would be labeled as a financial instrument, if it was going ahead, then it would apply to that other directive. The Marketing Financial Instruments Directive is a directive to help out the financial intermediaries, let's say the players in the market, to support and to help out and to give more information to clients on when they sell financial instruments. So it puts the responsibility at the financial intermediaries because they are the ones that are on the market on a daily basis. So to feel, and then it's not only directed at retail clients, it's directed at all the markets. So it's a comprehensive regulation that came into place in Europe in European Union, the second version in 2018. So we believe that it was not really necessary to bring it to there. And we do believe that the market abuse regulation or the definitions are not suitable to spot FX because, again, it's not considered a financial instrument. So why did we do that? Not only because of these opinions, but we looked back at the FX Global Code and actually, clicking this too much, sorry. So what happens is that the ESMA, why it's not, I think the batteries are probably going out. Sorry, I was clicking too much. Let me just go back. Okay, so I think we were here, exactly. So in the end, ESMA published their final report, and we were not the only ones with the same opinion. In the end, they didn't decide to go ahead with this suggestion because they said that that it was not. Basically, they acknowledged the feedback from the industry. We supported that report, and again, we believe that we need more coordination between central banks and national competent authorities. National competent authorities for the European Union market are the securities regulators, normally the securities regulators, and they are the ones supervised by ESMA. So ESMA does not supervise directly central banks in most of the circumstances, unless the central bank is also responsible for bonds and for equities in the country. But the vast majority of the regulators supervised by ESMA are the securities regulators in each country. So we believe that further analysis is necessary. And in the meantime, this was 2019 going into 2020. In the meantime, we did have the new package from the Marketing Financial Instruments Directive and Regulation, and Spot FX didn't come into that. But coming back to what I was just saying is that looking at the FX Code and going back to the prohibitions of the market abuse regulation, so insider dealing, unlawful disclosure, and manipulation of information, it is covered by the code. So you can see there, the FX Code 1 to 3 cover insider dealing. Unlawful disclosure of inside information is covered by 5 principles of the code. If we go into the information, the manipulation, it's already covered by 2 principles of the code. And if we go in trade-based manipulation, it's covered by principle 12 of the code. So in those particular ones, they are covered by these principles of the code. But generally, more principles of the code cover the past about the spot FX and particularly the issues about best execution that we mentioned. So again, a more detailed analysis of how the FX Code complements this regulation, not just the market abuse, but also the Marketing Financial Instruments Directive and Regulation in European Union. This is where the code is. This is where the code is absolutely excellent, because it helps a regulation or a directive, because directive then, of course, in Europe, a regulation is directly implemented into the country. The directive needs to be transposed by the country, but it is a regulatory act, each of them. And the code helps to supplement because it already contains. And of course, the code is not just for European Union; it's for all over the world. So it's important. It was an important measure, and ESMA was really sensitive to the comments from the industry. Okay, let's go now into the proportionality, which is a very important aspect of the code. We're talking about market participants, and we'll see that after these slides on proportionality. We're talking about central banks, not in all the activities. We're talking about commercial banks, investment banks, corporates, the head office, subsidiary, asset managers, pension funds, brokers, electronic, voice, e-trading platforms. There's a variety of market participants. And each of them, if we compare what, in terms of the principles that we'll cover, if we compare what a central bank can do compared to a family office, which is also a master market participant, I think we all understand that the applicability of some of those principles is completely different. Or if we compare an investment bank with a broker. So because of that different nature and size and different engagement as well in the FX market of these players that I mentioned to you, the FX global code has a very, very important, it's not a principle in terms of the 1 to 55, but it has kind of, maybe we, instead of calling principle, it was actually labeled as a principle by Jacqueline Law at that time, the Deputy Managing Director of the MAS, a principle of proportionality, but not to confuse with the 55 principle, but it has a framework of proportionality because it allows, and being with a voluntary nature, it allows every market participant, regardless of the type, size, and engagement in the FX market, to adopt the principles of the code that are suited for that engagement in the FX market. Again, a central bank might adopt 55 principles, but it might adopt 45 only. A family office probably might adopt only 20. But there are principles there for every market participant. And this is where the proportionality helps a lot. But not just in terms of the wording, in terms of these statements, but the Global FX Committee did something very, very important a few years ago, which is they launched a proportionality self-assessment tool, which of course you receive this, you have the link there, but it's always available in the Global FX Committee website. It allows, in a very, very simple way, if you answer 18 questions, it will give you a high-level summary of the principles that might be applicable for the entity that you have, or if you want to simulate what other entity would have, you would have the definition of the principles that might be applicable for your business. So that is a high-level summary, but there's more. Within the Global FX Committee website, and we mentioned this in, I think we did a few exercises on previous workshops, you also have the gap analysis template that covers not only the 55 principles of the code, but every particular section of those principles. There are principles that talk about the responsibility of banks, or as when they're acting as principals, when they're acting as agents. The same principle talks about the responsibilities of, for instance, Principle 9, clients, platforms, brokers. So within every principle, there's a few sections that are applicable for particular market participants. So that gap analysis template allows you to see the sections in every principle and then label them in terms of the applicability to your institution. So you can go in each of those sections within those 55 principles. For those of you that have already been seen the template in previous workshops, you remember that that is a comprehensive spreadsheet. The Global FX Committee, we requested for them to update it. They have updated a few months ago. That's with the new version of the code. So very, very comprehensive and allows you to go deep into every principle, detail what, if it is proportional, if it's not proportional. What is the idea there? Because it's a gap analysis template, will help you to look not only now if you want to implement the code, but also in the future, because it is a living document. If some of your practices and procedures, they change in that particular area of the code, let's go and focus the simple example of algorithmic trading. You don't do algorithmic trading. So you go there, principle 18, and you say not applicable, not applicable. But if your bank decides to do algorithmic trading, maybe then a few months later you go, okay, it's applicable. Okay, so then let's work on the gap analysis. It is really a big, big support, a very important support for your proportionality analysis, because it allows you to check that proportionality again, as I say, bless you, as I say, on an ongoing basis. But that is very, very important, okay? Proportionality is very, very important. Okay, so let's go now into the disclosure cover sheets. They have been, two of them have been updated with the recent version of the code. The whole idea of the disclosure cover sheets, so they are not as annexes to the code, but they are mentioned in several principles of the code because they help. Why do they help? They help in us understanding that in key areas of the code, like pre-hedging, like last look, like markup, to compare, because they are standardized formats, that to compare what are the services that are provided by one bank compared to one bank. If we want to go and do a transaction with one bank, we can compare the disclosure cover sheets, provided, of course, that they disclose. Some of them are public. And it's an easier way to go and see their pre-hedging policies, markup policies, last look policies. So instead of us just going to our contact at the bank or going to their website and these kind of things, sometimes are probably in some areas of the website that are not really in the home page. These templates help us to understand for each market participant exactly what they offer and what the terms of their policy, and then we can compare. The same applies to the platforms, and both of them were updated now with this version of the code. Okay, so going into the code, no change there. The introduction or four words still talks about history, organized, the complementing applicable law. We saw some example of that, and also talks about the definition of market participant. As it happened in the previous workshops, we did some examples there. Now we'll go some examples which I'll ask your cooperation, and I'll ask your responses to that as well. It's different ones than what we did before. I think the most important change in there was no change in the market participants. They're still the same. Most important change there is that the foreword or introduction now has 5 reports that were published over these years by the Global FX Committee. We'll cover that change in a minute. Let's talk now about market participants. So, first question. A corporate treasurer or treasury trading FX spot with one of his subsidiaries. Do you think this corporate treasury is a market participant for the FX over code or not in this situation? What do you say, yes or no? The idea is that we can go in and discuss these topics because, again, the exercises and the questions are not there randomly. They are there for a purpose. What do you think? Everyone agrees that if I said a corporate treasury trading spot with a bank, everyone agrees there will be market participant. What is the doubt there? It's because they are trading with one of their subsidiaries, right? But it is a market participant because even though we are trading with one of his subsidiaries, there is a movement in the FX market. Might not be a direct movement because the movement is just internal, but one of those entities might then go into the FX market to cover that amount or partial amount. And it might not be today, but there is a movement in the FX market. There is a transaction, even if it's done within the same entity, it is covered by the FX over code. So the corporate treasurer, and in this case, the subsidiary, is also, because it is a company, so both of them are market participants, so they are eligible for the code. A remittance business executing transfers in foreign currency to retail customers. What do you think? You remember what we mentioned in the previous workshop. For those of you, sorry, that have already seen the workshop, retail customers are not in scope of the code, but here I'm asking the remittance business. What do you think? Yes or no? Do I need to go around the tables? One answer, yes or no? In this case, because it is a remittance business doing a transaction with a retail customer, it's no. Okay? On their interaction with retail customers, it's not a market participant. Last year, on the previous workshops, if you remember, I put a picture of the Central Bank of Sri Lanka. Now I changed, I put the Bank of England. But we're coming with a different question for a central bank. A central bank executing forwards on behalf of their Ministry of Finance to pay for imports that are denominated in foreign currencies. What do you think? Yes or no? This one I need an answer, come on. Yes or no? Who says yes? Okay. Who says no? No one says no, I don't see that. Okay, it is a yes. In this situation, it is a yes. For those of you that didn't see A similar example last year, we had an example where we were saying that a central bank was trading FX swaps for monetary policy purposes. On those situations, it's a no, because of one particular exception that it's there on the definition of market participants that we'll see on the next slide, and it's a section of the code. But this one, it's not a transaction for monetary policy purposes. It's a commercial transaction, if we can say it like that. They're paying, I don't know, they bought ships, or they bought planes, or they bought helicopters, for instance, whatever the subject is. They're doing a commercial transaction on behalf of the Minister of Finance. So they are market participants. But if we go into the code, there is an exception that says, I'll read for the ones that are back. As a guide, the following types of persons or organizations would generally be expected to engage in FX market activities as market participants, as described in 1 to 4 above. Central banks, except where this would inhibit the discharge of their legal duties or policy functions. And it actually says not only the central banks, but when the central banks are executing transactions not directly but via some market participants, that can be an exception as well. But in this case, it's a yes. This is not a transaction for monetary policy functions. The same applies to sovereigns and supranationals. Those are the only two exceptions that are in the FX Turbo Code for the market participant. We'll come to that point. So let's go for another one. This is, I think, the third, according to statistics, the third largest pension fund in the world from Korea, NPS. The pension fund rebalancing its foreign currency exposures with a bank. What do you think? Yes or no? I see nodding, like this, not like this. Yeah, it is pension fund, even though it's covering our pensions as individuals. It is an entity, and most likely it is trading actively in the market, definitely, market participant. What about Western Union? A money changer trading FX through a broker. What do you think? We talk about remittance businesses. Last year we talked about money services. Now it's a money changer. But in this case, they're trading FX through a broker. What do you think? Yes? Yeah, it is a yes. It is a yes, because they are acting in the interbank market. Of course, they are trading through a broker. Who's going to be the other side? Probably another money changer, or probably a bank, which is normally when they access the brokers. Yeah, definitely. If it was a money changer with doing transactions with a retail client, that would not be, would be a no. That would be a no. An anonymous e-trading platform executing an FX spot between a bank and a corporate. Yes or no? E-trading platforms, yes. The fact that it's anonymous is absolutely irrelevant. Anonymous because, of course, then no one knows the identity, and of course you match the transaction. If you do have a bank trading platform, of course, everyone knows that you're going to deal with the bank that supplied the platform. Okay, it's a yes. How about this one? A pricing display platform showing indicative prices in the FX market. What do you think? Pricing display platform. Who says no? One person, two, more. Who says yes? One person, two, okay. It is a no because it's showing indicative prices. It's not valid for the market. And when we cover, when it could serve as information, but it's not valid to be a market participant. When we go into the part of the reference prices of market, mark-to-market valuations, we'll look into that. For instance, there's a strong recommendation that we should not use indicative prices for valuing our transactions. This is one of the reasons why pricing display platforms are not included in as a market, are not defined as a market participant. So in this case, a no. So no change there in terms of the market participants, only with those exceptions that we mentioned, the quasi-sovereigns and supranationals, central banks, if it inhibits the discharge of their legal duties and functions. In the case of quasi-sovereigns and supranationals, their institutional mandate. This is the bread and butter of the FX market, the ones that trade more quickly and more regularly with bigger volumes. Even family offices with treasury operations are there. The corporates, everything is there. It's probably easier to go and see the ones that are not. Pricing display platforms, retail clients, private banking customers, when they trade as individuals, and also if they trade by vehicles. And those businesses that we mentioned, remittance business, money changers, money brokers, indirect interaction in their interaction with the retail client. But when they interact in the FX market, then they are. They are on the previous the slide of the previous slide. Okay, now we covered the entities. Let's go to individuals and see, because the code says that market participants, and this is a very curious, but it helps us to understand a little bit better the higher and the increased responsibility that the FX code puts upon the senior management of every institution. When they define market participants as individuals, they say personnel, the firm, and the senior management, as if senior management is not personnel. No, senior management is also part of the personnel. But because of the enhanced responsibility that they have, not just to be role models for implementation of the good market practice, but in terms of some of those processes and procedures that the code implements, very much senior management needs to be identified on a separate manner, even though they are included in personnel. Personnel is everyone at a market participant. Okay, so let's see us as individuals. This case, risk manager of a hedge fund checking the transactions executed with their prime broker in the FX market. The person, the risk manager. It looks like he's really checking, right? But what do you think? Yes or no? Yeah? Yeah, it is a yes. He belongs to a hedge fund, is a risk manager covered by the code, and is checking the transactions that were executed in the FX market. And normally, of course, the hedge fund will do with a prime broker, because a lot of hedge funds try to protect their identity, and then they'll deal in the market with the prime broker. Okay, so definitely yes. A staff member from a corporate's back office executing transfers in foreign currencies related to FX transactions. So we're moving away from the front office, from risk. Now we are in the back office. Yeah, of course. The code covers not only the front office. Again, we mentioned, right? Risk management and compliance, 18 principles, confirmation and settlement, middle and back office, definitely. Okay. The personal investment vehicle of a private banking customer trading FX with an asset manager. We saw this just a few minutes ago. Private invest, not the private banking customer directly, but in this case, his or her personal investment vehicle. What do you think? Yes or no? Anyone for yes? Anyone for no? Okay, very divided, one against one. It is a no, because again, interactions with retail clients or with private banking customers, the importance is that with individual clients, be it directly or via vehicle, are not market participants. They are not market participants. What happens if we had there a family office That would be the head of the family office with the effects with an asset manager. The whole point there, by the fact that we're looking at a family office, is not just one individual. It can be two, it can be three or four, but that is considered a market participant. If we trade as individuals directly or indirectly, then we are not. A staff member of a bank advising a family office on the current state of the Forex market. This is not a transaction, it's an advising service. What do you think? I'm hearing my voice in the background. What do you think? Yes. Yeah. Investment advisors are also individual market participants. And in this case, of course, it works for a bank, but if he was working for an investment advisory firm, it would also be. Okay, it's one type of market participant. A bank teller selling banknotes in dollars to a retail client. Here I'm asking about the bank teller. No, yeah, it's a no, because we are trading. The fact that it's banknotes is irrelevant. The fact here is that we're trading with a retail client. So it's a no. And final one, the CFO of a corporate that has FX exposure. We all agree it's yes, right? Yeah. Again, senior management, yes. The fact that he has a corporate, and if the corporate has FX exposure, of course, he will have to be market participant. And again, in this case, this is why I saved this person for last. Very, very high responsibility to be responsible, not only to implement the frameworks, everything that we need to have responsible behavior in the FX market, but also as well to be role models of the culture that we all want implemented at any market participant, be it corporate or not. Okay, so in terms of the annexes of the code, they're still the same, just some updates. There were some 3 illustrative examples that were added. We'll cover them later. Actually, 2 of them we'll see in detail. They cover Principle 10, which one of them there was updated. The glossary of terms had 2 terms added. You'll see the curiosity of one of those. And the statement of commitment continues to be very, very important because it allows you, and your banks have already published the statement of commitment. Thank you very much in the Sri Lanka Forex Association website. That is quite, we promote that quite often to show that it's not only what is in the global index of public register, which is by the Global FX Committee. So you do have a statement of commitment that applies to the Sri Lanka market. It's very, very important to show which institutions have adhered to the code and go. And this is where now the Global FX Committee is expecting that and the local FX committees as well are expecting that market participants sign or renew the signature of their statement of commitment within 12 months of the publication of the code. So nothing much changed in terms of the statement of commitment. This is still the same. There is a change in terms of the composition of the Global FX Committee that we'll just see in a second. So again, we review the content of the code. This is something that we'll do today, or you can do it by reading the code. And we acknowledge that the code represents a set of principles generally recognized as good practice in the wholesale foreign exchange market. How do we acknowledge that? And this is where I want to bring you some updated figures for the ones that were in previous workshops. In previous workshops, this figure was 98. It's a small move. Now it's actually 99, and it's actually, when you make the calculations, 99.00. This reflects the current members of the Global FX Committee. So these jurisdictions are responsible, according to the BIS Triennial Survey of 2025, they are responsible for 99.00% of the daily volume of the FX market. So this is a perfect acknowledgement that this code, which is supported by these 20 jurisdictions, is a good set of global market practices for the FX market, because it is promoted, maintained, supported by 99% of the market in terms of volume. But of course, it's not only 99%, because Sri Lanka promotes it. Malaysia is not that, they promote the code as well. So there are some countries that are not part of the Global FX Committee, but they promote the code. So the real amount is actually higher in terms of jurisdiction, is actually a bit higher than 99%, because if we needed to calculate your daily volume in Sri Lanka, the daily volume of Malaysia, just as an example, you will add to that 99.00. So virtually the whole market supports the code. Importantly, since the last time I was here, the amounts from Russia are not there. We know what's happening in Russia, so they are not members of the Global FX Committee now. They do not participate in the meetings, but we have added Colombia. Colombia was not there 1 year ago, and they are now an associate member of the Global FX Committee. So I've calculated their amounts. Just one one apology here. It's not Scandinavia. It's now branded as Nordic Countries FX Committee, because the previous committee, and this was changed in the beginning of the year, had Sweden, Norway, and Denmark, and now includes Finland and Iceland. So that's why it's the Nordic Countries FX Committee. So I forgot to change it in the PowerPoint, but I'll change it when we'll send it to you. But anyway, besides the terminology, and actually, we compute, of course, Norway here, which is a big market as well on that. So we're talking about 99%. It's virtually the whole market supports the FX code and represents that it is a good guide for good market practice in the FX market. So the other parts of the statement of commitment doesn't change. We confirm that we are a market participant, and then, of course, by signing it, we commit to conduct our activities in a manner consistent with the principles of the code. And then, of course, comes the part about the proportionality, which is the third I split the statement of commitment in the 3 paragraphs that it has. This is the one where we talk about the proportionality. You have taken appropriate steps, depending, of course, on the complexity and size of your activities and nature of your engagement in the FX market, to align your activities with the principles of the code. So this is where the proportionality angle comes very, very handy. So where we are now in terms of the statement of commitment, again, it's just a way to public show, and very, very welcome way to public show, that not only you are signed the statement of commitment, but most important on the back of that is that you adhere, you implemented the good set of principles for good practice in the FX market. And it's a nice way to publish and to make sure that to your clients, to your stakeholders, to your investors, to your market counterparties, that you are adhering to the good market practice of the FX code. So the history now is a little bit on that. We're talking about the public register, but of course it is, as the code is voluntary, publishing the statement of commitment is also voluntary, so you don't need to put it on a public register. You can exchange bilaterally, internally, under request. So important thing is that you really adopt the code, and it's also important as well that you sign it. So you can see here a small evolution. Actually, there was a little bit of a decrease. I would estimate that with market participants renewing their statement of commitment over the next couple of months. I remember that we will probably have an increase on that, because some of them will probably renew, and then they will go and publish in the global index of public register or other public registers. So we might see a small increase in there, but it's very stable. So here you just see no change there, just one more participant public register that came up this year, which is Thailand. The Thai FX Market Committee now has a public register as well, and they have joined the Global Index of Public Registers. And this is, of course, the one from Sri Lanka Forex Association. So, and these are the other resources that you can see on the Global FX Committee website. The gap analysis template is the one that we mentioned, but there's again, all of these, we talked about this, we talk about this. We'll talk later if we have time on the survey. So there's a lot of information there that the Global FX Committee is adding to the website on a regular basis to help out with the implementation of the code. So going now into the review on a general manner, and then when we cover the principles, then we'll go into the particular changes of every principle. So it's still very much considered fit for purpose, but of course we need to ensure, the Global FX Committee needs to ensure that it remains current with industry practice and market development. This is why, even though the code is estimated to update every 3 years, the Global FX Committee and the local FX committees that are part of it keep paying attention to the market to understand if there are any needed changes, or in some cases, even if there are no changes, there might be some reports that are published to support the ongoing issues of the FX industry. So sometimes, even if you didn't have updates, if you remember when I put the calendar, there was some balls there in blue, because again, there was some. Those were the dates of the publication of some reports. So some of the official reports of the Global FX Committee were not launched when an updated version of the code. Even in July 21, there were 2 reports in August 21. We had the report in September 2020 about the COVID, the operational challenges about with the impacts of the pandemic, and there was no publication of the FX global code. So the regular attention and the regular feedback and provision of information for market participants continue, even if the code is only published every 3 years. So when they decided for the review of the code, they took into account several several pieces of feedback, if I can call it like that. So the BIS Market Committee provided feedback. There was a survey to market participants in September 23. I do hope that if we're looking now into a potential review in 2027, I do hope that by September next year we'll have a new survey, because it might help as well the Global FX Committee with the results of those survey plan for the 2027 review, because you hear the industry, surveys to local FX committees, and finally, just a couple of months before the code was updated, a request for feedback, which we also submitted some feedback on that. That was just a couple of months. So after collecting all of this feedback, they undertook these priorities for the review. Transparency and enhancement around certain types of execution activity, transparency enhancement on the utilization of client-generated FX data, and also as well about FX settlement risk. I'm not playing it out here in terms of which is more relevant than not, but I do think, in my personal view, that the FX settlement risk one is the one that was more important than the others. Out of the 5 principles, 3 of them talk about settlement, if you can look into that. And particularly because, of course, the other ones we're talking more transparency on client-generated FX data, it's needed. Of course, delegated execution is also needed, and it was something that covered in the code because there were some gray areas between the principal acting as a principal, acting as an agent. But the part about settlement risk is the one that suffered more changes because, again, settlement risk has been growing, and it's not good for the FX market, so we need to tackle that issue. And again, as I mentioned to you, some of the principles had already been changed in July 2021, and the market, the settlement risk, continue to grow. So we need really to tackle, and I think the Global FX Committee did very well in adjusting the principles on that. So when they undertake these changes, for December 24, and maybe they will continue to use this kind of criteria, but for instance, let's determine if there is a change to be needed. If the issue or the subject or the principle in this case reflects changes in market practice, structure, or environment to global FX markets since the launch of the code, probably merits a review of that issue, that text. If the practice takes place in the global FX market, remember we're talking about the FX global code is not for a local market or regional market. So it is important that that practice is applied globally. So that might then be a criteria for changing that relevant area of the code. If the industry practice in the area of concern would be improved through the development and industry-wide adoption of high-level principles of coded and examples, so then there is a new criteria for potentially reviewing the code, adding other topics, or changing some of the text. Also as well, if there is if a clarification of that issue, of that practice, could contribute to a good structure, functioning and communication of the FX market, then of course merits a change as well. And the final criteria is that if the current wording or the formulation of the issue principle, or if there is if it's not there, could be an impediment for some type of market participants not being part of the code or not being included in the code, or thinking that they would not have to adopt the code, then it probably merits a change. Because again, the code is for all market participants, and it's important that they're all covered, but, and a big but here, with the proportionality angle very well embedded and very well addressed by every market participant. So, coming back on this, the change from last year, a targeted review, not a comprehensive, it was still a targeted review. We had 3 illustrative examples, as I mentioned to you, as also mentioned 2 additional terms for glossary. We'll see the changes in the forward in a minute, just the addition of the official reports, and then the changes to the principles. So 5 principles, and as I mentioned to you before, 3 of them had been changed in July 21. And then the changes to the liquidity provider cover sheets. And coming back to what I mentioned before, that I think the settlement risk was the most important one. 35 and 50 talk about settlement risk. Actually, some of the text is actually emphasized in both of them. 51 actually talks about settlement as well, but in terms of the standard settlement instructions. But 3 of them related to settlement. So there is no doubt that there is something that we, all of us market participants, need to do in order to stop the growth of settlement risk and start reducing it after we stop it. Stop that growth. We'll cover all of these changes. So if we go on to the forwards, as I mentioned to you, 5 of the official reports of the Global FX Committee are there. There are 8, but only 5 were included, and there's a reason. But before we go there, let me tell you, as I mentioned before, that was a curiosity, 2 definitions included in the glossary of terms. Standard settlement instructions, which is covered mainly by Principle 51, but also the definition of value date. That is very, very curious, because if you're trading in the FX market, it looks like everyone should know what's a value date, right? It's probably one of those simple things. Well, you are market professionals, you are experienced, but some market participants in some individuals, in some entities that are also market participants, probably have, and they had some lack of clarity in terms of the understanding of value date. So the FX subcode in some of the measures might seem obvious, particularly for experienced market participants, for developed markets. Some of those principles, some of those recommendations might seem obvious, but in other markets, it's not. What's obvious for someone might not be obvious for the other. So this is exactly why the FX subcode can be applied globally. Even if some developed markets, some of those principles might be redundant. I already do this. Why are they telling me to do this? It's not, they're not telling, it's a recommendation, it's a good market practice. That is the whole point. Because it's a good market practice, regardless of your experience, regardless of where or on which market you work, you develop your role, there is a guidance there. It might be simple, and it might be applied for you for over 20 years. But some market participants might not know it. And this is why there was a need to clarify what are standard settlement instructions. There was a need to clarify what is a value date. And this came up. If you go to the glossary, you see there what's the definition of an interdealer broker. It's a definition of an agent, of a principal. So some of them are simple, but they help out market participants. And this is why the code is really global, because it helps everyone regardless, again, of the market that you're involved in and your experience. So there's 5 official reports. As I mentioned, there were 8 published. And you can see the 8 here. But the ones in bold are the ones that are included in there. And those are the most, I would say, probably, if I want to label it like that, those are the most technical. Because the first 2, really, first was the report on adherence. The one 1 year, no one really is that important, or no one really pays that much attention, my personal understanding, that why do we go back to what is the reality of the FX global code in August 18? We are in November 25, so it's not that relevant to be included in the version of the code that was published in December last year, or it was published in January, but it is the version of the code of December 24. So it's not that relevant. The same about the COVID. It was very, very important. It was welcome, very well received by the market in September 2020. But 5 years later, hopefully, if we don't get back to COVID, to a pandemic, we don't need that anymore. So, but anyway, those reports are there. They are on the Global FX Committee website. But they were not brought into this version of the FX global code because they do not reflect some technical aspects of some particular areas of the code. If you go, for instance, the last one talks about last look, principle 17. The one about pre-hedging, principle 11, that's still very much in the news, and we'll talk a little bit on that. The anonymous e-trading platforms, transparency, cover and deal arrangement. So those are more technical, and the whole idea of those reports is to help out the industry with more guidance, with further guidance about some particular areas of the code. That's why they were brought in. Instead of market participants have to go into the Global FX Committee website and look for those reports, they are now, those 5 reports, they are there on the FX global code, and you just click on the link and you get automatically redirected into there. I thought my voice was coming from there, but it's coming from my phone. Sorry, let me just disconnect this. I don't think I need to hear myself again. Okay. Okay, so that's the forward. In terms of next steps, so now, as we mentioned, the Global FX Committee is encouraging market participants around 12 months to renew the statement of commitment. Of course, it's not just signing the new paper, it's to make sure, of course, that you implement the changes into your practices whenever they are applicable, of course. Proportionality, always remember that. And of course, that it's really, really important that that statement of commitment remains very accurate over time. You can see here an example of some of the regulators that renewed their statement of commitment. For instance, if I can read it correctly, the Monetary Authority Singapore renewed or published in June 25, the Federal Reserve of New York in July. Just recently, the European system of central banks, where all the banks in the European Union, and of course the European Central Bank, they published now in November. In June, the Bank of England as well. I think the Swiss National Bank was around May. The Bank of Japan around May as well. So just some examples of banks that have renewed their statements of commitment according to the new version of the FX global code. It's very important for the industry as well to have this support from the regulators, and they're expecting everyone to do. But anyway, in terms of the next steps, and before we go into the main part of the code, so they're having a meeting in a couple of weeks. Again, the semi-annual meetings where they discuss normal interactions. They only meet semi-annual, but the local FX committees meet regularly as well. Last Monday, I was in a meeting of the Nordic countries FX committee to discuss, of course, what's going on in the FX market, but also as well the upcoming meeting of the Global FX Committee. There's an ongoing work to promote adherence to the buy side that will continue. Promotion of awareness and implementation of the code. We're very much doing that every week now. Of course, we need to analyze the results that are coming up, because the triennial survey of the BIS, some of the results were published in September, but the full report will be published in December, and then we'll look into that part, the settlement risk. And actually, I mentioned to you that if you're interested on FX swaps, we'll have a webinar next Wednesday, but also on the 20th of January at 10 o'clock Central European time. So let me make the calculations again. At 2:30 Colombo time, we'll have a webinar with a representative from the BIS to comment on the results of that survey. And also as well the final recommendations from the IOSCON pre-hedging following their publication of their report about 3 weeks ago. So these are some of the next steps, but there are some more, and I'll come back to you later on some of the topics that were discussed in July in Singapore at the last meeting of the Global FX Committee. So the work will continue. Dita. That's what's recommended, exactly. That's recommended. So that's why they're always talking about renewing. So is it necessary for our banks also to? It will be a good measure. It will be a good measure, because then if anyone wants to go and goes to your public register, if they go there, they will see the version that was signed last year or the beginning of, let's say there was a bank that published it in August 24. So everyone will know that that's not according to the latest version of the code, because it was published 3 or 4 months later. So that's why they are inviting everyone to renew the statement of commitment to have a new date. And the date updated to show that it's updated with the new version of the code. Sorry? Is it a good practice or is it a requirement? No, it is a good practice. There's no requirement, because there's no requirement to, it's not mandatory, but it's a good practice. It's recommended. It's recommended by the Global FX Committee. So this is why here, if we say, for instance, the Global FX Committee encourages all market participants to review the amendments and contemplate renewal of statement of commitment, considering the nature and relevance of the updates to their FX market activity, the proportionality. But they do encourage that a renewal of their statement of commitment is to be, or should be renewed. Yeah, but it's. Yeah. Sorry, yeah. So if anyone wants to go and get, I don't think it's only coffee, right? So there's some snacks there. So if you want to go, that's fine. Huh? No snacks. No snacks, only coffee. I saw something on the right, and I thought that's not coffee. But anyway, if you want to go, please feel free. If you want, bring it to your table, please. It's there for you. I think there are snacks. I see some plates there, and I see some things on the right. There are some snacks there. So please feel free, go ahead and get it. But it is really an encouragement. It's an encouragement. And the whole idea is that, of course, if anyone goes and compare and you see a statement of commitment, I'm not talking about Sri Lanka because all of you did last year, but if you see a statement of commitment that was signed in August 22, everyone would think, okay, so they haven't renewed it to the new version of the code. This is why it's recommended that it's updated. Do you want them to do a break? If everyone can go, 5 break? Okay, so we'll do a 5 minutes break. It's better than if everyone go. You won't miss anything. So, shall we return? Or shall we? Okay, perfect. Thank you very much. So we finished the part of the introduction. Now let's get into some questions, and of course then I'll ask your participation on that. And the questions are just with three alternative answers, so they mirror the structure of the exam. I'll ask you to consider if you answer 1, 2, 3. If you don't want to speak, please just go 1, 2, 3 in the order that they have. We live? Yeah, perfect. We are. Yeah, thank you. Okay, so first question. Adhering to the entire FX scope is always mandatory. This statement is false, false, or true? I think we all agree it's false, but which false? Because he has voluntary adherence or because he has a proportionality principle? One, right? Yeah, is voluntary adherence, so it's not always mandatory. The proportionality principle is not a condition for adherence to the code, but it is very important as a framework to adopt the code and embed it in your procedures, in your activity in the FX market. But it's not a condition. Of course, it is there to help the adherence of all market participants, given their diversity. Perfect. Okay, so the first one. Now another question. The classification as market participants applies to central banks and all their activities. What do you think? False? We've seen that, right? There are some exceptions, right? Yeah, everyone agrees? There's the third one? Yeah. So they are not considered as market participants where this classification would inhibit the discharge of their policy functions. Okay. Yeah.
If central bank, if one of the banks wants to do a deal with a bank, with the central bank, would that be
A market participant. That will be a market participant.
yeah, like we go to them and like they do a deal.
Yeah. You are a bank as a market participant. Yeah.
If they do intervention, no. But
No.
if we reach out to them, yes.
Yes. Yeah. You will always be, if you do that part, even if they do an intervention with you, you would be a market participant, but they will not be. So the impact here is on you. The bank would do, but if the central bank does it an intervention, they are not. If they do a commercial transaction, regardless if they initiate it or you initiate it, they will be market participants.
So when we reach out to them and do a swap, we are subject to.
You are market participant,
They are.
and they are not. They are not. If they do for policy, function.
We reach out to them.
But the question here is not who initiates the transaction. The question here is the purpose of the transaction. So if you do a transaction with the central bank for policy purposes, even if you initiate it, you are a market participant, but they are not.
It's not a policy purpose. When it's a large transaction, our banks probably opt to look at central bank option and cover that whole large deal in one go rather than we go to the market and
Yeah.
opposite the market. So
It's-
its purpose is the bank.
Okay, so both of you then,
It's not policy purpose of the
the two then will be market participants.
both will be market.
Both, exactly. But it's not who initiates. The purpose of market participation is not for who initiates the transaction. It is for the purpose of the transaction. But in this case, because you initiated and it's not for a policy function, both of them, both entities are market participants. Okay. Okay. So going into the third one. Sorry, I think the batteries are starting. Yeah. Oh, so okay, we have already the result. So which of these is not a Global FX Committee report, including the forward section of the latest version of the FX code? We'll answer this one. Of course, the answer is there. The whole purpose is, of course, it's not such a technical report that supports the current version of the code as the other three are. Body trading platforms and the transparency, disclosure, and transparency. So that's something that we saw before as well. Indicate which of these is a recommendation of the FX code. So it's an essential reference for conducting business. It's a comprehensive guide to doing profitable business, or it only serves for market participants when they are developing and reviewing internal procedures. What do you think? 1, 2, or 3? Well, anyone disagrees with 1? Why it's not 2? What's wrong there in 2? Exactly. So it doesn't teach you. The code is not there to teach you to do profitable business. That's up to you and to your institution. The code is really there for an essential reference for good market practices to promote the integrity, fairness, and transparency of the market, of the FX market. It's not really to teach you how to get more clients or get more money or what transactions you should do. Perfect. Okay, thank you. Okay, so these are the 4 for introduction. In the exam, there are 2 for introduction. We'll have more, and then I'll tell you a little bit also what we will supply. I was just speaking to Odita. Of course, the presentation, I didn't mention it before, but the presentation will be sent to you. We'll also send some sample questions that we have published on our website to help you out with the exam. And we'll also send as well the templates of the disclosure cover sheets and also the changes to the code. There was a report that the Global FX Committee published when they updated the code, or they published the updated version of the code in January this year. And it's very easy to go there and see the particular changes, all of those with highlights on track changes in red. You can see that. So we'll supply those documents instead of, if you don't have it, instead of going to look into the Global FX Committee website. So we'll supply all of that, but look at the sample questions because you have more there. Okay, so let's go now into ethics. So only 3 principles, very, very small, the smallest portion of the code in terms of the number of principles, but they're really, really the base of what we do as individuals in the FX market. So really here is to talk a little bit about us. How do we promote the highest technical standards? How we promote the highest professional standards? So that's principle 1 and 2. And also a little bit that how can we identify and address conflicts of interest. So these 3 principles on ethics are very, very related to our personal involvement in the FX market as individuals. And here, and we'll go and talk a little bit about some of these points, but here I just want to mention to you, and before we do the exercise, that what we mentioned before about the judgment. Some situations in the FX market are not that clear. For instance, and I think we have an exercise on that, or it was last year, but I think we have an exercise on that. No one is going to tell you that, for instance, that you work on and I actually had this situation in my previous life. The mother of my children, when we were together, we actually met because I was a trader at one bank, and she was a salesperson at that bank. And she was covering the FX. I was an FX trader. We're talking about 30-something years ago. And she was a corporate salesperson. So we would have direct relationship because when she needed prices for her customers or for the customers of the bank that she was managing, she would ask prices. From the moment that we looked into this, that we started to go out, we went, and there was no code. We're talking about 30 odd years ago. This was 94. We went to our manager and said, this is the situation. Are we allowed to stay here? So we raised the issue with our manager, with the head of the office, and he went then to the finance director in the bank, and he said, as long as they don't bring their issues into the dealing room, if they have issues, they discuss at night at home. There was no problem because we never discussed, we agreed on that. So the fact that you are working in the same department with your spouse, it's not a conflict of interest, but it might raise suspicions. So address them. This is what we did. I'm not saying that we did what just to show that, oh yeah, I'm the best one I did. No, we did a lot of mistakes. But on that point, we actually had the rationale, because we are big supporters of ethics in all the parts of our lives. And probably that's why we joined up. That's probably not the reason why we separated a few years ago. But anyway, that's another issue. The whole idea here is that we had the same idea. So we went to our boss and said, we don't see a conflict of interest because we can be professional. That's not a problem. But it might raise suspicions with your colleagues, with clients. So if there's an issue like that, no one is going to block it, not only because the code is voluntary in nature, but no one is going to block and say that you cannot work with your spouse in the same department. That's not a problem with your partner. Not a problem at all. But there might be a conflict of interest. So that's why the judgment, it's very, very important. And this is one situation, like for instance, oh, we come into Christmas, I'm going to have lunch with a client, and I'm going to take him to a restaurant that he's been looking for going for some time. Again, it's not a problem per se, as long as you go into the policies of corporate gifts and entertainment, and you keep within the framework and the thresholds of that policy. But the fact that you're taking a client to a restaurant that he's never been, and because you have a friend and you manage to get a reservation there just for a Christmas lunch, it's not a problem per se. But please look into those situations that other persons listening to that might think that there is a conflict of interest because, okay, because you've taken me to a nice restaurant, so I'm going to trade more with you next year. So beware of those. The part, we're talking about personal relationships, but it applies to various parts of the code. It's very, very important, this part, about the coverage of the conflicts of interest, particularly that we don't raise issues and we don't raise suspicions. So the judgment is very, very important. It's essential that we get the judgment right. Even though there are some situations which are gray areas. This is why I mentioned earlier, you already put the good market practice, you already put at the forefront of your activities the highest ethical and professional standards. So on that standard that you already have, which is very high, if you have a doubt, if something looks fishy, as I mentioned, dubious, don't do it. Don't go ahead and do it, because most likely it's not a good market practice. Then it's not recommended. So, for instance, market participants should act honestly, not only with clients and other market participants, including our colleagues, act fairly, and act with integrity, particularly in avoiding and confronting questionable practices and behaviors. This is a fundamental part of principle 1 of the code. If we go then for the how we should perform our duties, let me just open all the parts of the slide. How we should perform our duties, of course, then we need to be appropriately trained, because we need to have the technical knowledge, ethical and professional conduct to perform our roles with efficiency. But we also need, and the big emphasis there, not just the technical knowledge, not just the expertise, but also as well that constant and sustainable, responsible behavior in all activities that we have. The code also talks a little bit about potential adaptation of the good market practices that are here with your internal codes. If you have internal codes which are related to involvement in the financial markets, and here I mentioned financial markets, not only FX market, because the code does have particularly these areas. This is not only for FX. We're not talking about FX, and we're talking about 3 principles of ethics that relate to us as individuals involved in the market, be it from the front office or operations or risk management, the CFO. So it serves for all asset classes. So it is important that if you do not have an internal code of conduct for the Treasury, or if you have it and you want to improve it, this could serve as well as a complement to those internal codes of conduct. One important thing as well here, which is that they promote, in case this is not done yet, they promote as well, or they recommend that when you're going to do the staff, the performance reviews, semi-annual or annual, you consider not only the financial performance of those persons, but also as well your standards of behavior. This is naturally done, but in some institutions it's not done. They're only looking for the money that that person generated. So we need to embed this culture of constantly evaluating our standards of behavior so that we can raise them. In terms of the conflict of interest, there are three particular areas that I mentioned in the code. Personal relationships, I just mentioned my personal example. Gifts and corporate entertainment, I mentioned that example as well. And also policies on personal dealing. The code does not say, again, it's voluntary adherence. The code does not say that personal dealing is forbidden. No, it doesn't say that. What it says is that because of the potential conflict of interest that might occur when you are doing for your own account and you are, of course, working for a bank which is involved in the FX market, but this, again, could work for any asset classes, that there need to be policies and controls for those kinds of activities that you have for your personal involvement in the market. So it doesn't say that you cannot do it, but let's prevent and manage that potential conflict of interest that they might have, because you have notice of, and you have primary, you have preliminary, and you have really priority of information what goes on in the market when compared to someone else which is not involved in the market, because you are in a bank. You can be in the front office, or you can be in the back office, but you have access to the market. So it's natural that you want to do personal dealing. It is allowed, but high risks, high controls to make sure that we don't raise conflicts of interest. So this is a section of the code of the one of the principles. High standards of conduct is, of course, knowledge of and complying with applicable law, relevant experience, technical knowledge, and qualification. This is the part on the other three codes that they actually go ahead and mention our exams. Acting with competence and skill, professional judgment as well. So the whole idea here is that let's engage in efforts to strive for the highest standards of professionalism in the FX market. So this is what we need to put into the forefront of all of activities as being market professional or market participants for the FX market. So just these three principles, again, as I mentioned, talk really about us as individuals, regardless of the function that we are. As if we are a market participant, we are covered by these three principles. Let's go and do some exercises on this. Ethics. Which of the following is correct regarding personal dealing? We just mentioned that. So we mentioned that it's permissible, right? So we cut to number two. Number two is not the correct answer. What do you think it is? Only it's one or it's two? So one is allowed for everyone, and two is saying that it's allowed for everyone as long as they are outside the front office. Why? Because, of course, front office, you have access to primary information from the FX market. But what does the code say? What do you think? It's one or three? It's for everyone, or only for someone that is outside the front office? One? Yeah, it is one. It is one. The question here about the front office could be like, okay, so they have primary information about what goes on in the market. But imagine the current situation, or this situation. You are a risk manager, and you are working together with your corporate area because there is a client known by the bank, it's a current client of the bank, that is working on a merger and acquisition transaction. And you are on the risk manager because, of course, when the client will want to go and do a transaction potentially with your bank, you need to have the limits. So that risk manager already has primary information of a sizable transaction that will go into the market. So he's not in the front office, but he knows that something will impact the market. So it's not just for the front office. It's for every market participant, in this case, individual covered by the FX Code. This is just an example. Okay. Question 2. Name an effective arrangement to eliminate or manage conflicts of interest. Which of these is an effective arrangement? I think we all agree, given that we had on the previous one, 2 no, right? We cannot allow personal dealing activities with no policies and controls. What about 1 and 2 and 3? What do you think? Anyone? 1 or 3? Gut feeling? 3. 3. Yeah, we go for 3. Sorry, I didn't understand. 3 is the right one. We need to establish information barriers, and there is one word which I'll repeat a lot later on in the code: independency, not one word, various words. Independency, segregation of functions, segregation of duties. This is a particular part of the code in various aspects. Segregation of information barriers so that you do not have access to information that would probably lead to inappropriate use and then raising a conflict of interest. So it's very, very important. The first one is not correct because there's no problem with changing the duties of personnel as long as those duties are changed, they're properly documented, and of course, again, they also establish that there are information barriers and there's knowledge that might be acquired. If you are, for instance, moving from the sales department to an FX, to the trading department, you were working on a big transaction to a client just a few days before that hasn't been executed. Of course, when you go into trading, you already know probably that the market will have a sizable movement. But again, just with some information barriers, not just in terms of the functions, that's fine. But there's no prohibition in the changes of the duties of personnel. So establishment of information barriers is the right one. So we go into the third one. On the subject of entertainment, what is recommended by the FX Code? Which of these 3 do you think? It can be received subject, it can be freely offered and received, or it cannot be received from clients. 1, 2, or 3? 1? Yeah. So it can be received. That's a part of it, regardless of where you are in the world. In some countries, actually, sometimes an insult if you don't accept a gift from a client or a corporate or an entertainment. So 3 is not correct, but it needs to be accepted according to policies and controls, and those policies should establish thresholds of what you can receive. If you need to go above that threshold, you should really ask authorization from compliance, from the head of your department, ideally from those 2, before you go and receive that. The whole idea here is, again, and it's not to go against the practices in some countries or in some markets. No, the whole idea here is to prevent the potential conflict of interest. The situation I mentioned to you about the lunch. If we go into an exclusive restaurant, of course, that's not a problem, as long as that is pre-approved, even if it goes above the predefined threshold. But that needs to be fully identified to prevent other situations happening as a result of that lunch. So it is the first one. Which of the following are arrangements that market participants should put in place in order to eliminate or manage conflicts of interest? I think we mentioned that the first one is not correct, right? I mentioned my example. What do you think about the other 2? What do you think? It's 2 or 3? 3? All agree it's 3? We cannot get free information to clients for as much as we would like, because it would help us to trade more with us. But unfortunately, we cannot get all information to clients. Some information, and we'll cover that when we go into the information sharing, is confidential and should remain like that. Okay, so it is 3. And this is recommended by the code. Training to relevant personnel on an ongoing basis so that we can identify and handle conflicts of interest. Okay, perfect. So now we go into governance. But before we go there, any questions so far on the ethics and on introduction? Any questions? Any queries? Oh, sorry. We'll cover that when we go to principle 14, which is just now in execution. Do you mind waiting 5 minutes and we'll cover that on that? Because the whole idea is that, again, is it a recommendation of the flexible code? The whole rationale is transparency. Transparency to the bank and transparency, particularly in this case, to the market. This is the rationale behind suggesting or recommending that you apply a markup policy. But in order to apply that markup policy, you need, bank, if you want to do that, you have some recommendations of what you can put in that policy. And we'll see some examples of policies that, in my view, are not very well done, because they don't disclose what is recommended by the flexible code. But we'll cover that. If you don't, I will go back to you. I'll explain it, and we'll talk a little bit more on that. Yeah? Okay? Perfect. Thank you. So, any more issues here before we can go ahead? Yeah, so we'll cover that on the execution part, which will come after this one. So let's go now to 4 principles of governance. And similar to what I mentioned before on ethics, that we had 3 principles basically for our personal involvement as individuals, as persons. Here we have the 4 principles, very, very small as well in number of principles, but forms the base of the framework, that effective governance framework that we should have for putting in practice the good market practices that are recommended by the code. So it is really a base to what we'll see after, I think it will be just after lunch, what we'll talk a little bit about the risk management framework, the compliance framework, the audit framework that will help us to manage and identify the risks the 7 risks identified by the flexible codes. But so this is really the base in terms of what we should have, the governance framework. And here, very, very important is the responsibility of senior management that I alluded to earlier. So these principles actually talk about senior management need to put in place an operational structure with totally independent control that allows for an effective oversight of all the FX market activity. And it is a responsibility for senior management not only to make this available to everyone, but also as well to be highly visible and a role model of a responsible, ethical and professional behavior in the FX market. So this is, for me, one of the most important parts of the governance, not just the establishment of this framework, but the responsibility of the senior management in putting in place, in ensuring that every individual involved in the FX market, being front office or risk management or compliance or back office, has that role and has an environment within the bank, within the firm, it's not only for banks, has an environment to be able to practice those ethical and professional standards to the highest level that it's really recommended. But, of course, there are some that don't do that. And, of course, this principle also says that that framework should have channels for people to speak up with absolutely confidentiality. If you do witness that someone within your bank or within your firm, or within your institution or outside is not really performing according to the good market practices recommended by the code, you should have confidential channels to report so that they can be investigate it, collecting the evidence, but without any problems for you. So the whistleblowing is really should be put in place by an institution. Then, of course, everyone needs to be aware that if you have some unacceptable behavior, or if someone has unacceptable behaviors, could be subject to disciplinary action. So the senior management should really have this structure in place. And these principles also talk a little bit about the, again, connected to the conflict of interest that we saw before, but how we should put in place remuneration or compensation and promotion structures that really are robust enough to avoid conflicts of interest. We all witnessed, we all heard in the past that we saw people trying to force transactions to clients, mis-selling to clients because they had a quick bonus as a result of all more commercial activity with clients. So we need to go back and reduce or potentially even eliminate those circumstances. So mis-selling or suggesting to clients when we should not suggest, because only advisors can suggest. So there are some certain circumstances that raise naturally a conflict of interest. So, and then it's connected to our, mostly our variable pay. So it is important that those situations are really controlled. The FX code does not say the variable pay is bad. No, because the bonus, the variable pay, it's important. But it does say that it needs to be aligned with the interest of the firm. But we'll cover that. So the basis of the governance principles, 4 principles on that. The key features, again, segregation of duties, again, to avoid a conflict of interest. Also, the independency of the functions and mechanisms. So it's very important that everyone can perform their duties protecting confidential information so we don't raise conflicts of interest, but also with independency. A risk manager, for instance, should not be involved in revenue generation activities because, again, he needs to protect the independency of his area, of his particular role. Of course, there is also the need for transparent lines of responsibility. Everyone needs to know, particularly on investigations of malpractices. Everyone needs to go where they are, and everyone needs to go what they are, reporting lines in a very transparent way. And of course, in order to supply this, you need 2 things which are absolutely essential. You need management information, and that management information needs to be also put in some situations or in some circumstances to senior management, but also senior management should be and should create an environment that allows everyone to challenge the senior management, because senior management needs to be responsible for that practice, for that environment of ethical and professional behavior according to the highest standards. And if they don't do that, the environment should allow for that senior management to be challenged. Again, what I mentioned as well, the responsibility, enhanced responsibility that needs to be taken by senior management into this. So what I mentioned before about the FX code recommends that there is a balanced between fixed and variable compensation, as well as the form and just the timing of that. And very important as well that, again, they're not blocking variable pay, but they say that all remunerations and promotions should align interests of the personnel with those of the firm, both on the short and the long term. We had circumstances where, for instance, there was a push, so we have a campaign of 3 months to sell a particular product to a client. Let's go and push it because we all have in those 3 months, and then we will receive the bonus after the campaign is closed after 2 weeks or 1 week. So again, nothing wrong with that, but not in a way that would force the sale or would do a mis-selling. So this is why they come up with these principles about the balance, not just in terms of the fixed pay and variable pay, but also as well in terms of the timing, in terms of the form that they are paid. Probably not all in cash, some of them in stocks. So a little bit, a few recommendations so that we start or that we continue because of course the code was launched a few years ago, continue avoiding conflicts of interest that were created in the past because of this. And the part that I mentioned to you about the reports, investigation and reports of improper practices and behaviors. But of course, as well, very important that those persons perform those duties with independency and have the sufficient skills and experience to investigate those reports. And then, of course, then the result of those reports can go to your senior management internally, but in some cases it might go externally to the regulator as well. Depends on the gravity of the case, if the case is really, really serious or not. Okay, and this is the part about governance. Let's go and do some exercises. So, according to the guidelines of the FX Global Code, compensation should only align the interests of the firm, but on a short term, should always align on a long term, or the variable pay is not a good market practice. I just mentioned to you, it raises suspicions, but of course no one in the code does not say that variable pay is a bad market practice, but it needs to be controlled and it needs to be put in an effective way to eliminate conflicts of interest. So what do you think, 1 or 2? It's only on a short-term horizon, or it's always on a long-term horizon? What do you think, 1 or 2? Do I need to start going around the tables? Or we do that after lunch? 2, yes. So it's always on a long-term horizon. You can consider short-term. It's good, yes, but it's not only short-term, okay? It's always on a long-term, but you can consider short-term as well. Who should investigate the report of improper behavior of a trader at a bank? Who of these 3 persons should be? Investigation of the report. The head of that area, an independent function, or staff member of the regulator? An independent function, everyone agrees? Why not the head trader? The head of the boss of the person. Why not? The conflict of interest, right? Yeah. Yeah, exactly. So the independent function. Of course, there is one important issue here on the back of this. For you to investigate a report of improper behavior of a trader at the bank, it needs to be an independent function. But that independent function, the person with that role, needs to have knowledge, skills, and competence to investigate. If that person doesn't know what happens on the trading area, that person cannot go to the head of trading. That person cannot go to someone else. So the market participant, the entity, needs to put in place effective arrangements, including training and knowledge and hiring persons that know what goes on in there. So this person is not a trader. This person might be in compliance, but needs to know, that person in compliance needs to know what happens on trading. Otherwise, that person will not do a correct investigation. Okay? And also with systems, if needed, depends on the situation that occurred. Okay? So heightened risk for compliance, they need to understand what goes on. They don't need to be ex-traders, but they need to understand what goes on in the trading. Otherwise, the report will not be that robust. Or the investigation, which will lead into the report. Who's responsible for putting in place an effective oversight of the market participants' FX market activity based on appropriate management information? So the body that is responsible for financial soundness, or the body that is responsible for the business strategy, or for both? 1, 2, or 3? 3? Yeah? For both financial soundness and business strategy. It's very, very important. Business strategy doesn't mean that where will I make more money? No, it doesn't mean. It just means that business strategy, oh, we cover large corporates and SMEs, but we don't cover retail. This is a business strategy. It's not where we're going to go. The idea here is not where to make money. It's the strategy of the bank for, in this case, for the FX market. Okay. Senior managers are models of the desired good market practices, so they are not subject to disciplinary actions resulting from unacceptable behaviors and transgressions of the market participants' policy. This statement is false, and if you think it's false, which false, or this statement is true. They are not subject to disciplinary actions. Two, everyone agreed? Even though, as I mentioned to you earlier, and it is on the code, that when they name individual market participants as, who are market participants for the FX over code? The firms, personnel, and senior management. You remember I mentioned that today. They are separated, but that does not excuse them to be also guilty of malpractices. So, yes, they are subject to disciplinary actions as well. And I would say that they would be the ones, because they are supposed to be the role models. They are supposed to be for implementing what a bank or what a firm needs to do, or a market participant needs to do. So they should be very much subject to disciplinary actions if they don't follow those procedures. According to the FX code, who should be responsible to investigate potential improper practice and behaviors at a market participant? We now mentioned, before we mentioned this trader, the individual, now at a firm. In this case, at a bank, for instance. Who's responsible? Senior management, external auditors, or any parties and functions with skills and experience to conduct them? Two? You can, it is two, if needed, as a result of that report coming out of that investigation, you might need, depending on how serious the situation is, you might need to go externally, even to external auditors or to regulators or even to senior management. But they are not the ones that should do the investigation. So it is really any parties and functions that have sufficient skills and experience to conduct these investigations. Which of these is a factor that should be taken into account in the remuneration and promotion structures of a market participant? Any salespersons here? Any traders? Just to see who's going to get one or not, because yeah, I'm sure if the salespersons would not agree with one, but the traders would. Okay, we can skip out one, right? What do you think? Last one, again, talks about short-term horizon. We saw before at short-term horizon, it's not enough. It needs to be on a long-term horizon. So I hope you all agree that that we need really to have appropriate mechanism to discourage those malpractices and behaviors. Okay. Now we go into execution. Before we go to execution, any comments, doubts, questions, preoccupations, observations about governance? All good? No changes in the code so far. Everything is the same as it was before. Now we go into the area of execution. Well, we'll cover the changes to principles 9 and 10, and we also address the question on the markup that was raised earlier. Yeah, all good? Okay, so we should go with this probably until lunchtime. Okay, so execution. 11 principles, and this is the part where normally clients would say, buy-side clients say, no, this is not applicable to us, this is only for the sell side. Well, that is, I'm sorry, that is not correct. that is not the correct stance, because there's a lot of responsibility from clients in adopting the code, and we'll see some of those examples, particularly in those principles. And when we always think about the proportionality, of course, the proportionality is exactly for that, to help the clients and all market participants to adhere to the principle, to the code, according to the principles that really make sense for their activities in the FX market. Okay, so now we go into principles, the first two principles, Principle 8 and Principle 9. So Principle 8, no change, talks really about the two main capacities for market participants when they are handling orders. And normally these, when you handle orders, normally these you consider banks. But it's not only for banks. But it's normal that the clients give the orders to the bank, and then the bank would say that it's acting as an agent, so handling the order on behalf of the client and taking no market risk. Or the bank might say that it will handle the order as principal, which means that the bank will take market risk in connection with the order and would act in the market on its own account. So, and this is a very, very important definition, and we'll talk a little bit over the course of today. A principal, and both of them always in the activity of handling orders from clients. A principal takes market risk and acts in the market on its own account. An agent doesn't take market risk and acts in the market on behalf of the client. So no changes. These are the two capacities that are there. When we go into Principle 9, we talk about the way that these two market participants act, but we also talk about other types of market participants. So if we go into the principal role, in order to handle orders fairly and with transparency in line with their capacities, we cover the principal and agent first, as it is on Principle 8, and then we have responsibilities for principal, disclosing terms and conditions, stating how, or disclosing how risk will transfer, because you remember, principal, they manage risk, and they take market risk, and again, here, they take market risk. An agent doesn't take market risk, so an agent also needs to communicate the nature of the relationship, seek to obtain the result requested by the client, and also as well be transparent with the fees and commissions that they have in their terms and conditions. So, when you are doing a transaction and you are stating to the client and you have a pre-existing agreement that you act as an agent, there might be a situation where in that particular transaction you say, I need to be a principal. And you will handle the transaction as a principal. But in order to do that, you need to get the agreement from the client that you will proceed as a principal. So you can change, you can alter your capacity in one particular transaction only once. If you are an agent, you can change to a principal. If you are a principal, you can change to an agent. There are circumstances where, for instance, depending on the amount that the customer gave for the order, or depending on the volatility and the liquidity of the market, you might need to change that capacity, because in your judgment, remember professional judgment, you will think that that change of capacity will allow you to better manage the transaction of the client, always thinking in the benefit of the client. And even though if you are an agent and you go there acting on behalf of the client, when you are handling transaction as a principal, you are also handling an order from the client. You are also looking for the client. But in order to do that, you might need to be a principal and take on market risk. When we go and talk about pre-hedging, you can only do that as a principal, because normally it's for amounts that have the potential to cause a large impact in the pricing of the market and the resulting liquidity and resulting and causing a lot of volatility. So it might be the best way to defend a client order to act as a principal. Instead of just saying the client comes to you with a very, very large amount that you know will cause a big movement in the market, and you just got an offer and a bid. No. Sometimes you need to manage that order with some time ahead So you can try not to disrupt, or you attempt to not to disrupt the market, which will be bad for the client and then for you as well. So they are both acting always in the benefit of the client. And it might be in the benefit of the client for some particular transactions that you need to be as a principal. So principle then 9 talks about the responsibility of these two, but it also talks about the responsibilities of e-trading platforms, and also talks about the responsibility of interdealer brokers. That they have, of course, rules, that they have subscription services, they also need to know how risk will transfer, and they also have restrictions and requirements, and they need to disclose to clients how they will be done, or to market participants. But also, as I mentioned before, the clients are here. The clients need to know the responsibility of the others to whom they are giving the orders. They need to know the transaction risk, and they need to evaluate the service. So, if a client has a big amount and goes to a bank, give that order, and the bank says, we have an agreement that I'm an agent, but because the order you gave me, it's really a big one in terms, and it could cause disruption to the market, I need to be a principal. The client needs to understand why the bank is changing as a principal. And the client, if he decides that he will accept that explanation, it will need to agree on that. The bank can only go on that change of capacity if the client agrees to it. You have an agreement signed for agent, and in that particular transaction, because it's sizable, the bank will ask, I need to act as a principal. The bank can only go ahead as a principal on handling that order if there is an agreement from the client. So, if the client gives the agreement, the client needs to know the market, and he needs to know the responsibilities of the bank. So the client needs to know the code, needs to know what's expected. The clients cannot excuse themselves from the code. They are market participants. They need to know what is expected from them, even if that expectation is to understanding the responsibility of the market, understanding the transaction risk, evaluating the service, and understanding why a bank for that particular situation is asking for a change of the capacity in which it will handle. Clients, buy-side clients, should not really be excused from the code. They should really be adhering to the code, because they need to understand what is the responsible engagement in the market, because they are acting in the market. They are players in the market. They might not do 100 transactions a day, but they might do one that is enough and could cause a lot of issues in the market. When you go in this principle, and it says that market participants should handle orders fairly and with transparency in line with their capacities, it says that all of these market participants, when handling orders, they need to have clear standards, they need to state the truth, they need to use clear language, they need to understand whether the prices are firm or indicative. A client cannot go and ask the bank, what is the current level of the dollar against the Aussie dollar against the American dollar? And the bank gives a price. I want to buy 5 or sell. No, they ask the level. So they need to understand. If they want a firm price, they need to state that they want a firm price via a recorded line, not via text message or mobile or a message on WhatsApp. No. So the clients need to understand. We'll come back to that point on the information sharing. The clients also need to know that the banks, or the market participant, in this case the bank handling orders, has a potential to reject orders if the probate is deemed as inappropriate for the client. This is a recommendation of the code, because the bank is the one that is in the FX market every day, all day long. So if they think that the conditions of the market are not that good, it might be good then to say, let's reject the product for the client. But the client needs to understand why, again. None of them can transact to disrupt the market. And, of course, relevant information needs to be provided before. So it's very, very important that all of these 5, e-trading platforms, interdealer brokers, client, agent role, they fully understand that they need to perform these duties. We'll talk a little bit later, but an example of a client. A client goes to a bank and says that I want $20 million against any other currency. Is that your full amount? And the client says yes. If the client says yes, he cannot be calling any other 4 banks for 20 million. Because if the price is good, the client might not deal only with you 20 million, he might deal with the other ones. The client is not obliged to say that it's a full amount. He may decline to disclose it. So I'm giving away an answer of a question that we'll cover later. The client might decline to disclose it, but it is a good market practice that the client disclose it. Because if I get a quote for 20 million, I'm in a bank, I ask the client if it's full amount and he says it's not, how am I going to show my price? My price is probably not going to be for 20. I'm going to try to guess that the client is probably calling another 3 or 4 banks. If the client tells me that it's for 20 million, and I agree with the client, and the client is stating the truth, again, stating the truth, then I'm going to price probably a shorter bid-offer spread, or closer, or tighter. So the clients need to understand that they need to state the truth. Otherwise, the integrity of the fairness and transparency in the market cannot be there only with the banks. It needs to be with all market participants. This is why the code includes all of those market participants that we mentioned. Just another reason. Anyway, now we go into the part of the orders. And there are orders that are manifested in the code, shown in the code as very, very relevant. For instance, stop loss order, fixing order, filling an order, partial fills. Also, it talks a little bit orders with sizable amount. It's just not here in the sketch, but it is on the text. Also, as well, the orders with full amount that we just mentioned. So there are orders that are more sensitive. The clients, for instance, if the client gives a stop loss order and says that I want to sell if my trigger is at 10, the market is 12, 15, and they say I want to sell as a stop loss, my trigger is 10. The client needs to understand that if the order is executed and the price of the market falls, the order will not be executed at 10. The trigger level of an order is not the final price of an order. And if there is markup on that, the markup may impact the price of an order. This is one point of the markup that we'll talk a little bit in a few minutes. So the clients need to understand how these orders are handled. It's not just giving the order to the bank. How they're going to make sure that the bank is handling the order correctly and is giving them enough disclosures if they don't know how orders should be handled. Again, they should adhere to the code and understand that these particular orders are a little bit more sensitive. The pre-hedging, the 12, will cover that here in this part, and then later on a particular section because of that IOSCO result. Only as a principle, because again, these orders normally have a sizable market impact, and they can cause disruption to the market, so normally there are orders given by a client to a bank to manage that order. But of course, in order for the bank to do that, needs to get an agreement from the client, but also needs to disclose to the client that the bank is doing pre-hedging. It's not doing front-running. Two completely different things. And sometimes the line between them is very, very thin. But it needs to be understood that pre-hedging is a good market practice, but it needs to be fully understood by the client. Front-running is not a good market practice. But we'll cover that later. That's on Principle 11. Principle 12 is the one that you remember before. We talked about the market abuse regulation, those prohibitions. So really, really promote market integrity. Do not do collusion. Do not do manipulative practices. Do not do spoofing. Do not do wash trades. That is covered on Principle 12. Principle 13 talks about reference prices, that if you have a transaction like a derivative with another institution, if you want to, if you don't have a book that you can value the mark-to-market of that derivative, you can rely on the information provided by that entity. That's fine, but you are already trusting that entity. Adopt some policies and controls. If there is a price that there is a third party, again, not on pricing displays platform, but if you use a broker price or a screen price with tradable prices, you need to agree with those counterparties that you can get the valuation from the third party. But there are policies and controls as well that you should agree in order to trust that reference. So this is covered by Principle 13. Principle 14, we'll talk about markup, and we'll come back into that. We'll see some examples. Not just that it needs to be fair, but also that there is the responsibility of market participants to publish the markup policies, but also as well with sufficient detail for clients to agree. This is a recommendation of the code. Principle 15 says that market participants should identify and resolve trade discrepancies together with the operations department, but sometimes the discrepancy on a transaction might originate from a incorrect entry in the front office. So this is why this is here on the execution part. But from then on, independency on functions, segregation of duties. If the issue is brought by the front office, from that moment on, operations, risk management needs to be involved, but front office gets out of that investigation. Again, independency, segregation of duties so that it does not create conflicts of interest. And this is why, coming back now to Principle 13, is when we provide valuations, it cannot be the front office defining what are the valuations, be it with an external party or be it with the or be it with a third party of the products that it traded. Front office trades, the valuation needs to be found and measured by another department with segregation of duties. It would be nice, right? You remembered what Mr. Nick Leeson did like 30 years ago, right? He did the product and then he was revaluing it, right? And he was changing. Okay, now I feel like having a profit today. Oh, tomorrow I have a small loss, right? Yeah, but that cannot be done. Voice brokers. Really a principle to say that voice brokers should not solicit or accept favors for switching. Switching should only be done when there is insufficient credit between two counterparties. Only on that we should do switching, not as a favor being requested or being given. And of course, voice brokers cannot take transactions on their own name. They are just intermediaries, and they should do on that. But we all know that sometimes there is a slippage, there is a difference on the market, very volatile, and sometimes they are stuck with transactions on different prices. But they should not take those transactions, and they should not ask and give favors for switching. Then we come into the last two. The last look, basically about the last look is a practice on electronic trading platforms that when a liquidity provider on that platform receives a trade request from a client, before it accepts or not, it has a chance to accept or not. The question there is that if the trade request is not accepted, it exposes the client to market risk, because the transaction, let's say if the market is 18.20 and the client says, I want to buy at 20, and then a few moments later, sometimes within a second, if the market is already at 22, it's normal that the liquidity provider will not accept selling at 20. That is fine, but the clients need to understand that when they undergo and trade with platforms that have last look, those clients need to understand that the provider of liquidity, the platform, doesn't take advantage of that confidential information because he knew that the client was going to trade. It could be a small amount or a big amount. Cannot take that information to its own advantage. So the purpose of last look is just to allow that the trader or the liquidity provider has a chance to reject if the market price moved in the meantime. The clients need to feel very confident that it's not being used for inappropriate usage of that information because they manifested the way to deal with the transaction. Again, coming back, the clients need to know this. And they need to know this by understanding last look, and by adhering to the code, they understand their responsibility. So the responsibility here is to disclose the last look policies, but the clients need to understand it. They cannot say that, oh, I'll go and deal in the platform. Oh, I was rejected. Why? No, they need to understand. If they sign up to that, they go to the platform, they sign the agreement, they need to understand what's in there. The last one is really about, sorry.
Last look, can you elaborate, like when we going to the platform and hitting it directly, like now we have implemented healthcare dollar also in a platform.
Yeah.
So we just go and hit, and like the liquid provider doesn't have.
They have a split. Sometimes it's even on the so quick the platforms are. Sometimes it's within a second. They have a chance to refuse it. And normally they refuse if the market price is not there anymore. That's changed. But of course, what's the problem? If you are a client, you run market risk because you haven't done the transaction. The example I gave, it's if 18.20 and you want to buy at 20, but in the meantime the liquidity provider changes to 22, you lose the price at 20, and maybe you don't want to buy at 22. You are running market risk because you haven't been covered on your transaction. That is fine. The problem here is that the liquidity provider rejecting the trade, he knows already that you wanted to buy at 20. So he has confidential information. The issue here is that he cannot use that confidential information to his own benefit. This is why there are disclosures of last look, so that the client understands that the liquidity provider is only changing that because of the impact on the market price, not because they're taking advantage of that for his own benefit.
No, in the implemented live platform that we have in Sri Lanka, doesn't have that option.
Okay.
So basically, like
Doesn't have last look.
doesn't have the last look.
Okay.
We
Okay.
have one click hit and it gets it.
Okay. And it
Meantime,
always the same price. Okay.
Yeah, he honors the same price.
Okay.
But like both interbank parties, maybe we have adopted the local code. Okay, and like maybe other than that platform, direct transaction probably would have happened at 22.
Yeah.
But in the meantime, it's still at 20 and it gets also.
It
hit.
gets done. How often?
There is no last look.
So you don't have last look again. You don't have that. But how often does the price change?
There are days that is very volatile, so it can happen. Basically, same example can happen. Like we might get hit on the on another platform or on a vice broker.
Yeah,
By
yeah.
the time we get to know, like
The price might change, but then the platform will honor the previous price then.
liquid provider did not have the last look.
The last
option,
look, yeah.
so it gets hit there also.
Yeah, yeah. Okay. No, I understand. Okay. The previous price will always be honored. Yeah. Okay.
It's the responsibility of the liquidity provider to
Exactly. To honor that price.
information and
Yeah.
accordingly change it.
Yeah, yeah. Yeah, but if the client already requested that, that's fine. So there's no we will see that there's no last look window. There's no time for the liquidity provider to think that he might change the price. No. If he accepts the price, that is the price that will take. Perfect.
My concern is this is how it is happening in Sri Lanka. I hope that this will not be a hindrance.
No, it's not a problem, because if you don't have last look, you don't apply principle 17. This is only for, again, and it's only for e-trading platform. So if a bank does not have an e-trading platform, doesn't apply. And if that e-trading platform doesn't have last look, you don't need to use principle 17. You're not going to go and implement last look just because of the code. No, the proportionality. If you don't use last look and the platform doesn't use last look, you don't apply principle 17.
I'm talking about a common platform. The buyers and sellers are both in.
Yeah.
I understand in a normal like foreign bank providing
Of course, yes,
platform,
yeah.
it has last.
It has like, yeah, but for clients, no.
Yeah.
Yeah, yeah. That's not a problem.
This is the common platform where both liquidity providers and they.
So again, you apply the last look and you apply the guidelines of the code on your interactions in the FX market through other platforms, be it local or external. But in your interactions with the client, you don't, because the platform that you have with the clients doesn't have last look.
So we claim ourselves only at times
You don't lose last look all the times. Yeah, exactly. Yeah, yeah, yeah. Because you use last look in the interbank market with other platforms, the external, but you don't use it when your client platform. Okay, And the final principle on principle 18 talks about disclosures, that the need for market participants to disclose several aspects of like strategy fees on algorithmic trading and aggregation services. Aggregation services are the ones that are normally the funds where they might have someone dealing for a fund that wants to do $1 million, but they have 10 funds, each of them for 100,000, just simplifying the example. There are some disclosure that they need to take, because you can deal the 1 million, but straight after you have to input the registration of the 10 transactions that you did, each of them with 100,000. But there's a lot of disclosure on principle 18 regarding these two services, but we'll cover that. So this is just a briefing of the principle. Let's go there in more detail. So as I mentioned to you, principle 8 talks about the principal and agent, and also as well the difference, or if they want to alternate the capacity. Remember what we mentioned: principal takes market risk, acts on its own account. An agent doesn't take market risk and acts on behalf of the client, but both of them in the situation of handling orders. But as we mentioned, the handling orders is not just exclusive for the agent and the principal, it's also the responsibility of clients, e-trading platforms, and interdealer brokers. And they need to understand what measures are being applied on the handling of orders, as we just mentioned. So they all have responsibilities on that. So this is covered by Principle 8 and Principle 9, but Principle 9 actually got changed to, for instance, Principle 9 also covers, as we mentioned, the responsibility of e-trading platforms. So the changes come that in order to enhance the transparency of client-generated data or data of FX transactions, that the new version of the code encourages e-trading platforms to provide better disclosures about the sharing of FX data from client interactions with third parties. And also as well, they say that there is a requirement for enhanced clarification of third parties, that because those third parties might not be subject of the additional disclosures that should be provided by the e-trader. So it is really for the e-trading platforms to disclose not only in terms of the transparency of the client data, but also as well the clarification of third parties. And this connects really, really nicely with the disclosure cover sheets that I mentioned earlier. There are some changes to those, and I'll provide two examples to you, and we'll see them in a few minutes. One for liquidity providers, typically banks or multi-trading platforms, and another one for e-trading platforms, where normally the liquidity is provided by one single entity. So the changes here very, very minor, and particularly for with a focus on the disclosures provided by e-trading platforms. And again, the part about the promotion of the users of disclosure cover sheets, because on those disclosure sheets you can see very, very well the different policies, and you can compare what services and the level of service and the terms that are given on those particular areas. So this is Principle 9. Then Principle 10, important change. So the introduction of delegated execution. So delegated execution is a principal initiates the trade on behalf of the client. Very, very important. First point here is the initiation of the transaction is by the principal, not by the client. Then we need to have a written agreement. So initiation by the principal, not as an agent, this is not applicable, always as a principal. Initiation as a principal needs to have a pre-agreement with the client. Doesn't run market risk. So when we talked about on Principle 8, the principal on that capacity runs market risk, and the delegated execution, the principal doesn't run market risk. So principal initiates the order, principal and client have an agreement, and the principal runs market risk in connection with that order. There needs to be transparency of the fees and costs associated with that order. And also, the client needs to have all the tools and the ability to evaluate the quality of execution. So, delegated execution, initiation by the principal, a pre-agreement needs to exist. The client needs, there's no, the principal takes, let me start again. Principal initiates the order, pre-agreement existing and between client and principal. Principal takes no market risk. There needs to be transparency of the fees and costs associated with the order, and the client needs to regularly evaluate the execution of that order. These are the 5 important points for delegated execution. The question here is that in the previous version of the code, we were talking about the principal, the traditional principal that takes market risk, and an agent that doesn't take market risk. But there are situations, like the delegated execution, where the principal will handle the order for its own account, but it's of course an order from the client, and will not take a market risk. So there was then a need to create this additional. It was not a capacity. The capacities remain as true, principal and agent, but there is this middle solution, let's say it's this hybrid solution for delegated execution, where the principal doesn't take market risk. But it needs to be the principal initiating the transaction. There needs to be a pre-existing agreement, doesn't take market risk, transparency of fees and costs, and evaluation of the order by the clients. So all of these 5 conditions needs to be assured for it to be delegated execution. Coming back to the disclosure cover sheets that were covered on Principle 9. These are the changes into the liquidity provider disclosure cover sheets. Again, as we mentioned before, transparency, improved transparency and comparability of current data sharing practices for the liquidity provider, with the details there, what section has been added. And also when we go into the platforms, is exactly the same, improving the transparency and comparability of current data sharing practices, but there with a table that contains these details. We'll see them, actually let's see them now. Let's see them later, because this one particularly is actually very it's a table, it's a spreadsheet with various columns, very hard to see. But I'll share that with you later and just make sure that we have because they are on PDF, just want to make sure that they go live as well for the broadcast. But we'll see them later. Let's continue here and let's go into the markup before we go for lunch, and then when we come back from lunch, I'll get those into the platform or into the screen. Okay, so the handling of orders, as we mentioned before, some orders have really some more, probably more sensitivity than others. We mentioned this, stop loss, fixing orders, partial fill, orders that might have a sizable market impact, orders of full amount that we mentioned before as well. So these orders, the policy of orders needs to be, of course, normally it's the clients asking the bank. The bank has the responsibility to put in place disclosures for the clients to understand how these orders will be handled, but the clients also need to understand those policies and also understand that the bank will be acting on their behalf, but they are always subject to the market. And the pre-hedging, not as an agent, always as a principal, as we mentioned before. Normally orders that have sizable market impact that are given with some sufficient time for the market participants to execute in order to not protect the market, not disrupt the market. And this afternoon we'll cover that, not only talking about the IOSCO, the pre-hedging, but also seeing some examples of pre-hedging. Then we go into the prices that we mentioned. You remember that we mentioned the part about the the market abuse regulation, where we're talking about the market integrity, and we also talk about the historical rate rollover. So the FX over code recommends that market prices are at current rates, not historical, and actually as well that we shouldn't really do spoofing, flashing, wash trades, collusive activities, manipulative activities. We really should do all the transactions at current live prices or rates, but we shouldn't really do transactions that would cause bad things to the market. And also as well that we talk about, we refer this to the reference prices. What kind of controls, what kind of arrangement do we need to have in place if we do a derivative and we trust the valuation of the counterparty that we did the derivative, or if we trust a third party. So we need to have controls and policies to understand. But of course, as well here, please, when we're talking about procedures, of course, segregation of duties, independency of functions is guaranteed. If the front office trades, but it will not be involved then in the valuation of the products. And then we go here into the markup that we mentioned before. So the FX over code recommends that there are transparency and disclosure implemented by clear documentation for clients to understand that the final price may be inclusive of markup, but also as well that markup might be different from client to client. In some examples, actually, instead of having markup policies for each client, normally some banks have said that no, for large corporates I have one markup policy, for mid corporates I have another one, for smaller corporates I actually have another one. So you can sectorize, and you can actually sector do any other way, like for industries. Oh, for telecommunications I have one, for I don't know, for energy I have another one. So you can you can have different markup policies. This is the setup, and the recommendation again is to help the clients to have more transparency on that markup. But very, very important as well on that is that you need to tell the clients as well that markup may impact pricing and execution of orders. The example I mentioned earlier, if you have a stop loss order and you have a trigger, you need to impact the markup, but the markup should be impacted after the order is executed. So if you have a price of 10, 12, the current price is 13, 15, and the client says, I want to sell at, my trigger is at 10, and you have a markup of 2, let's say, so you will execute the order when 10 is an offer price. This is the normal on stop loss orders when you sell, which means that the next price might be the next bid because you are selling in the market. Next bid will be 8. So the execution price will be 8. But if you have 2 points of markup, the final price of the client will be 6. So the clients need to understand that markup is impacting, but also that you should apply it after the order is execution. If you apply it before, the order might not get executed. So the clients need to understand that, and that is a responsibility in this case of the market participants, particularly the banks, to put those policies in place. And again, comes back to the point that we mentioned before. The clients need to understand those policies. They need to understand how they're done. And then when we go into the disclosure of markup, we need as banks to show how markup is determined. I put there a few examples. Does markup includes capital charges? Does markup includes credit value adjustment, the CVA? Does it include transaction costs? Can it change depending on market circumstances? You have a policy with a markup with a client, but there might be market changes where there's a lot of volatility, there's very few liquidity. You might go ahead to say to the client, I'm sorry, but I cannot apply the markup that we have agreed. You have the right to do that, but the client always has the right to say, okay, so I don't want to trade with you because you're changing the markup policy. So whatever you put in the markup policy in terms of bringing more transparency and helping the client to understand that, of course, you need to have a margin if you are a bank because you need to cover for capital charges, for credit value adjustment. There might be transaction costs. Of course, there is a cost. But the clients need to understand that. And they will understand if you have a very robust markup policy. Does that answer your, yeah? Pre-agreed. They should really actually have a policy. When you onboard the client, ideally, if it is a new client, you should really have the markup policy already agreed from the outset. If it is a current client, there is a time where you should go to that client and say, look, from this moment onwards, the bank is applying a markup policy. Are you okay with that? If the bank is not okay with if the client is not okay with the markup policy, because you need to have the agreement with the client, there are several solutions that happen here. You might not trade with that client, or you might put the price that you want on that client, but the client will not have the transparency. So the client will not be benefiting. They might not be understanding the market and knowing that there's a markup, but they should know that the markup is perfectly valid, and this is why it's recommended, because there are costs. But you should really have that pre-agreement with the client.
Markup policy, yes, we have. Customers also understand.
That's good. Perfect.
Problem is disclosure, to be honest.
The problem is
Disclosure.
but the problem for the clients? For the clients?
Yeah. Clients also understand that we have all these
Discharges, yeah.
the charges involved. Because of that, we charge this rate also.
Exactly, yeah.
They all both are accepted. Based on volatility also, all are there. Our only problem is disclosing that to the client, like officially, and getting it pre-agreed.
Okay, yeah. But if they understand the markup and the rationale for markup, they should understand then when there is a disclosure and then when the markup is applied, right? They should, right? Because if they agree to the markup policy, they should understand it. It doesn't make sense for one, for instance, we mentioned is, for instance, just say a commission-free negotiated with you in advance. Okay, negotiated with you in advance, it might be in a different way, it might be called as a markup, but it doesn't say that there is a policy. But negotiated with you in advance. Does that mean that in every transaction with every client the negotiated process? Or it might infer that there is a market policy. There's this market policy is more detailed. This one for me, sorry. This one for me is not good. Any sales marginal markup, any. It doesn't even say that it's negotiated in advance. So, just some examples of markups that are not that relevant. This one's, in my point of view, this one, for instance, the retailer, I mentioned this in the past, it was a purchase I've done in the airport in Copenhagen, and it's a retailer, and for me, private individual, but they actually tell me what is the markup that they applied in the euro against the Danish krona exchange. I didn't negotiate it in advance, but at least they give me the information afterwards. And this one, I saw it on Sunday when I was coming here to Colombo. This is in the airport of Dubai. Transparency in exchange rates and full disclosure on markups. I couldn't find that shop. It's not really a shop because that's United Payment Services, but I need to get into a transaction to understand what do they mean by full disclosure on markups. I'm very, very curious. This could be the one. I'll keep looking for it. If I have it, I'll set up to it. Actually, it says transact seamless at Dubai duty free and many other shops in the union. I need to find it. So it might be a platform. We need to go and we need to have more disclosure on markets. But of course, they need to be as well flexible because the market conditions are different.
Can't be right. Also accepted maybe somewhere else.
Yeah, but I think it's a platform. I just saw that and I took a picture of it.
Also accepted.
Exactly, yeah. So it could be someone else. Could be someone else. I was just running to the probably. I was running to the plane and I just took a picture and I didn't investigate, but I was definitely sure because I'm full disclosure on my account, so I'm curious of that. Okay. So going into now, so just to finalize, just ask you 2 or 3 minutes before we go to lunch, and finalize the execution, then after lunch we'll do the exercises. So we'll talk a little bit about the discrepancies. Of course, front office probably is the area where the discrepancies are noted, but from then on, the discrepancies need to be evaluated by independent function, normally risk management or operations. These principles also talk about the prime brokers, that the prime brokers as entities that normally trade on behalf of their clients, normally to protect the identity of their clients or confidentiality. So they should also assume the credit risk because prime brokers in this case, they are market counterparties, as opposed to voice brokers. Voice brokers are not market counterparties, they should be only intermediaries, and they are mentioned in the code as the entities that when they perform switching of transactions, that is okay. If they meet 2 counterparties that do not have credit limits amongst them, they are okay to ask a switch and have a new counterparty or third counterparty stepping in the middle of them. But they should only do that. They should never ask or accept favors for name switching of transactions. So again, because of the mention what I mentioned before, that sometimes there might be a different price because the market grew, and sometimes they might ask, oh, sorry, I bought at 18 and I sold at 20. Can someone come in the middle and give me those 2 pips as a commission later in the month? Sometimes this happens given the speed of the FX market. That could not be done because the brokers should not act as principals, but they shouldn't really ask or accept favors for other than or name switching. Name switching should only be when there is insufficient credit between the 2 parties to the transaction. So then going into the last book, as we mentioned before, we referred before that it's really a practice for trading activities. The responsibility here is of the market participants to have the policies and make the clients understand the impact and
accept the trade request, the client has market risk. So let's go into the process of last loop. Client requests a price. Liquidity provider at the platform always receives the price request. Liquidity provider supplies the price. So, and then here we have the last loop window. Starts. The client, looking at the price that was supplied, asks for a trade. Liquidity provider receives the trade request, and the liquidity provider validates the price. But that price might not be the same. It might have changed. So the liquidity provider from here has two options. If he validates the price that it was given before, they accept the trade, no problem at all. If they decline the trade, the client has market risk. This is what here the client hasn't accepted. The issue here is making sure that in this last loop window, from the moment that the client is asking for a trade, and when he asks for a trade, he gives a direction, I'm going to buy or sell, and he gives an amount. From that moment, the liquidity provider cannot misuse that information to his own benefit. He needs to protect that confidential information. And this is why the policies on last loop are applied. They need to be understood by the client, particularly if the client, as a result of last loop, has the trade required. But the clients need to understand those policies. I need to understand that they might run market risk if the transaction is required. Okay, and then the part about the, although it's here, this is the same, just about the need for more disclosures throughout the code. I put it here because, of course, not only the last group has a lot of disclosures, but also as well on algorithmic trading and aggregation services. There's a lot of disclosures on what we should provide the client before undertaking those services. For instance, describe the strategies, describe that there is confidentiality, that if the service can execute confidentiality, that the service can execute as a principal, what are the frames applicable, if there are conflicts of interest, and then these two which are for algorithmic, what kind of algorithmic preferences are defined, are determined, and information liquidity sources when you are doing aggregation services. So principle that really talks about the disclosure that should be given to clients when you are providing these two services. And that's basically the principles on execution 8 to 18. When we come back, we'll do a few exercises on all of this. So it's 12:34. We can go now for lunch and then be back. Probably when I ask you again, please do not come back after 1:40. Instead, have 1 hour, 5 minutes should be enough. So we can restart. Okay, so I'll see you in a second.
Okay, let's restart. I hope you had a good lunch. So, as we finished with the part of execution, let's do some exercises now. The usual request, please let me know if you agree which of the answers you have you select. Okay, so we go for question 1. Which of the following is a characteristic of a market participant acting as an agent when handling a client order? It can run market risk up to a certain limit, can run market risk with no limits, or it cannot run market risk. What do you think? All agree with 3? Yeah? Remember? Thank you. Agent, no market risk, acts on behalf of the client. A principal runs market risk and acts for its own account. Then we have the delegated execution with those 5 ideas, but here just difference between principal and agent. So it will be the 3rd. Thank you. Market participants acting as interdealer brokers on an order from a client should have markup policies, be transparent with the client about the terms and conditions, or establish clarity regarding the point at which market risk may transfer. What do you think? 1, 2, or 3? We're talking about brokers here. Any ideas? Let's go. Do you believe 3 is okay? What is wrong with 3? 3 is not okay. What is wrong with 3? It's a broker. Supposedly it doesn't run market risk, right? It just acts as an intermediary. So 3 is not applicable. How about the first? What did we discuss as a precondition for applying markup policies? In which capacity? Do you remember? As principal, exactly. Only as principal. A principal takes a position, can trade on its name. A broker cannot. So it's not as a markup doesn't apply to brokers. So it is be transparent with the client about the terms and conditions. One very important point when you go and look at the code, not just for the exam, but the implementation of the code, of course, in your practices, do not study the principles in isolation, because several of them are really, really connected. So here is really just elimination of those 2, and the second one is the correct answer. Okay, the 3rd. Which of the following is a recommended practice when market participants handle a stop-loss order from a client? Disclose to clients that stop-loss orders can only be executed if markup is applied. Disclose to client that other transactions on risk management may be executed next to the trigger level of that stop-loss order. Or disclose to client that stop-loss orders will be executed at the trigger level. What do you think? 1, 2, or 3? I'm going to start going around the tables. I always have this table answering. Yesterday was exactly the same, so I started going around the table. So please, this table, what do you tell me? 1, 2, or 3? We talked about markup being something that we agree with the client, but did we say that it could be conditional to a stop-loss order? No, we cannot. We agree with the client, but we cannot condition the execution. Markup may impact the execution of a client order if we put the markup before executing it, but it cannot be a condition. We cannot say to the clients that I'll actually only execute a stop-loss order if we apply markup. No, that's not something that we should do. It's not a good market practice. Explain to client that if there is a markup, of course, the order, the trigger level, and the execution of the order may be impacted, but not as a precondition. So we exclude 1. Is the 3rd correct? We cannot guarantee, right? We cannot guarantee. One thing is the trigger level, the other thing will be the execution level. And normally they do not coincide. And normally the execution level is worse to the client than the trigger level. So are you all okay that we go for 3? 3 is okay. Why? Because we are executing a stop loss order, but we might receive orders from other clients for risk management. Not a problem at all. And they might impact the trigger levels, particularly if the trigger level is connected to a level on a technical analysis, on a chart, on a graph. Most likely, a lot of customers know already, and they could put trigger levels close to the one that we receive. But we are not dealing only for that client. We're dealing for all the clients. So it is okay to disclose to clients that there might be other transactions. We should not disclose the amount or the identity or the applicable price of the trigger level. But we can disclose that we are handling other transactions that may be executed next to that trigger price. That is something that we can do, and it's not sharing confidential information. Okay? So that will be number 2 here. Okay. The next one. A corporate should regularly evaluate the execution they receive from a relationship bank. This statement is incorrect. If it is incorrect, which one of them? Or correct? I think we can exclude the last one, right? Cost per corporates, we said they are in scope of the code. So should they regularly evaluate the execution? No, it's not necessary, or it is a good market practice. What do you think? It's 1 or 2? Anyone? 2? Yeah, it's 2, exactly. It is a good market practice. We mentioned that, right? But in order to do that, clients need to understand how to evaluate, so it's always recommended that they adhere to the code, in this case, a corporate client. How should a market participant act as an agent on a client order? Very similar to what we looked at, so we know the answer on this one already. Markup is applied as principal, right? So not connected to agent. Do we remember pre-hedging? When are we acting as handling a client order as a pre-hedging order? Do we act as a principal or as an agent? A principal, exactly. So as an agent, as we saw before, no market risk connected with that order, so it will be the last one. Next one. Which of the following is a recommended operating practice for when market participants provide aggregation services? Information on the liquidity sources, whether the service provider can execute as an agent, or provision of general information regarding how routing preferences may be determined. I'll go with this one because we covered this just on the disclosure, and it was very, very quick. It cannot as an agent. It can only do aggregation services and algorithmic trading services only as principals. And the routing preferences are for algorithmics, not for aggregation services. So in this case, will be information on the liquidity sources that will be accessed in order to provide those services. So it will be the first one. Please look at the disclosures that both of these services need to have. They are principal 18, and there are just small differences regarding liquidity sources, which is applicable for aggregation services and also for the routing preference to be applicable, of course, for algorithmics. When does confidential information arises on last look? Please look at this very, very well. When does it start, confidential information? We looked at that graph with the last look window. When does confidential information arises? We mentioned this, so you got this. Come on. Let me tell you, what do you think? It's the first, second, or third? So after the trade is executed, is that when confirmation information comes? After the trade is executed? No, right? Okay, so that's a no, because we already know, right? But when the question here is when it arises, when it's brought up. When a market participant refuses a trade request, it can refuse or it can execute. But that time already the confidential information is already there when the trade request was made. And when was the trade request made? At the start of the last look window. Okay? That is, remember the graph. The client asks a price. Liquidity provider receives, checks the price. If the client then requests a transaction at that price, but informing the amount and informing if he's buying or selling, that is when confidential information arises. And then on last look, market participants should ensure that they're not taking possession of that confidential information for their own use. They're only executing the transaction from the client. So will be at the start of the last look window. According to the FX Sobo codes, which of the following is not a capacity in which a market participant may act when receiving a client order? Everyone agreed with the first? We mentioned about agent and principal, right? Did we ever mention about riskless principal? No, right? But this was actually under conversations over the market before the code was updated, whether there should be a third capacity coming into principle 8. Because we mentioned, not by this name, but when a principal doesn't take risk. Do you remember? What did we mention on that? A change to the code. Delegated execution, you remember, right? On delegated execution, a principal doesn't take market risk. But there's no definition of riskless principal, even if on delegated execution, the principal takes no market risk. Okay? So it was not applied. But there were some conversations in the industry saying that, oh, maybe we should go and have a third capacity on principal 8. That was it was not accepted. It was just go into the definition of delegated execution, which means much more than just the name of riskless principal. What is recommended by the code for market participants so that their clients are allowed to compare data sharing policies more easily? How can they compare? We covered this as well. What do you think? One, two, or three? Okay, I need to start going by tables. Can this table tell me? 1, 2, or 3? Anyone? Or just show hands. 2, right? Everyone agrees? We talked about it, right? The disclosure cover sheets, right? That is a really an effective way, and they got updated just recently to be able to compare the data sharing policies of market participants on the liquidity provider and on the platforms as well. Okay. And the final one for execution. FXable code states that market participants should make clients aware of how orders are handled and transacted. Does that include whether orders are time prioritized? Do you think time or prioritized it's important? Or also aggregated as well? Do you think the priority or the being able to record when clients send their order to us by the time priority, do you think that is a really nice way, good way, effective way to handle and trade on orders? What do you think? No, and it doesn't really include aggregated. Yes, and also if they are aggregated, and or no, only applicable for when orders, whether orders are aggregated. What do you think? Do you think type priority is relevant? In some exchanges it happens, right? You do need to define the time priority. Whoever went first, that's principle first in, first out. Applicable in some exchanges. The same applies here as well. Time priority, even though it's not mentioned in the code, it is a good market practice. But also in this case, also as well, the orders can be aggregated. So it is an effective way to handle the transactions or the orders given by the clients. Okay, perfect. So on execution, any questions, any comments? No? Okay, so let's go then to information sharing. 5 principles, very small as well, but very comprehensive in terms of what we can say, what we can disclose, how can we protect and limit access to confidential information, and also the way that we can say and we can communicate with other market counterparties and also with clients. So split into 2 areas. The first principles only talk a little bit about the definition of confidential information and how to handle. And that definition mentions that it's FX trading information, and we'll see the details very, very soon. It's just the normal activity that we have, order books, information on fixings, information from trades from clients from the past, current, and future. That is the general activity that we have on a daily basis on the FX market. But there is other information that is more ad hoc, more occasionally, particularly if we have an example, if we have some merger and acquisition transaction, which probably needs a higher level of protection in terms of the confidential information. This is why we have then also included within the definition of confidential information, we have designated confidential information requirement there because of the sensitivity, higher sensitivity of that information. It could lead to us having to sign non-disclosure agreements because it could be very, very relevant for the market. And that's basically what the first principle will say. Then principle 20 will mention a few exceptional circumstances in which a market participant is allowed to share confidential information to external parties. And then when we go into the communications, it's really about the way that we communicate in a manner clear, accurate, professional, and not misleading, but also as well how can we communicate market color in terms of information of the market. Shall we really say that that company bought dollars yesterday and they are going to do it again? No, we cannot. But we need to continue communicating to clients and give them relevant information because we are the ones on the banks, on the asset manager, we are the ones that have regular presence in the market, and the clients rely on us that are in the market every day to provide that information. But we cannot provide that information in a way that will unprotect the confidential information in a way that will share sensitive information. So we need to be very careful on that. And the last principle as well talks about the methodologies on how can we share that information about the market, or also as well information about activities, expectations on the market, and also flow activities. So WhatsApps are not allowed, but we'll come back to that point, just as an example. So here on the next slides, then you'll see the definition. Well, confidential information includes these two, and you'll see what is FX trading information, as I mentioned to you, the regular activity of day-to-day business, but considering, of course, past, present, and future. And if you go into the designated, it's that one where, for instance, remember merger and acquisitions, maybe it's even more proprietary, it's even more confidential, and maybe you need to have a written no disclosure, or in some situations you can establish a Chinese wall to make sure that no one else than appropriate has particular access to that information. But both of them are considered confidential information. So the code then goes to talk a little bit about that includes confidential information, but also mentions that if you receive information from a client, only use it for the purpose that it is supposed to. Coming back to what we mentioned on last look as an example. If you receive confidential information of a client saying that he wants to buy at that price, that particular currency pair, you can only use it for the purpose that it was given, not take usage of that information for your particular involvement in the market or for sharing with other market counterparties. No, only for the users that it was given, or for the specified purpose that it was given. So let's limit confidential information. That's a good market practice, only to the parties that really have a valid reason to keep that information. Of course, if there is a need and this is internal, this is still internal, if there is a need for the legal department to have trade information, for the compliance, for the risk, that is fine, but only if they have really a valid purpose to share, to keep that, to receive and keep that information. So it's not just information that, or the circumstances that we can disclose it to external parties, that is coming up, but also internally we cannot freely share to everyone. There must be a rationale, a very valid rationale, to share that information internally. So now we go into the external. There are exceptional circumstances where we can disclose it external. For instance, if we obtain the consent from a client, if it's requested by the central bank or other relevant regulatory or public authority, if it is necessary to settle transactions. If you are trading with a broker, of course, you are allowed to share that information about the bank, what you did, your identity, of course, because the broker will settle the transaction that was done with another entity. So that is perfectly obvious. But the same applies for when you do innovations or amendments or cancellations through a broker. Or when you are dealing with another market counterpart. Of course, you identify your not only the name of your bank, that's perfectly inherent from that, but you also have the amount and the currency pair that you're trading. But also, if it is required to be publicly disclosed by applicable law, and also as well to advisors or consultants. Again, coming back to an example of a merger and acquisition, there might be a need whenever two companies are merging that advisors, consultants, they come back to you and say, we need to have all valid transactions that this company has done with you, for instance, and we need to supply it, but they must assure that they need to protect that information the same way that we do, meaning that we are the ones disclosing that information. So the exceptional circumstances that we can share it externally. If we then go into the way that we communicate, so clear, non-ambiguous terms, appropriate terminology should be used, and then we really need to identify when information is attributable to a third party. If we hear that it was on Bloomberg, let's refer it that it was on Bloomberg to a client or to another market party. Let's not exaggerate. I heard it, I saw it on Bloomberg, but I actually have a friend at the central bank. Don't change the origin. Identify, it was on Bloomberg, regardless if the client has Bloomberg or not. If it is on Bloomberg, name the source. Don't exaggerate. Don't make it even more convincing that the information is. And that is real information, but when we go into the part of rumors, that's even more true. If it is a rumor, don't say, I heard it from a very good source. I have inside information. We cannot go and do that. If it is a rumor, it remains as a rumor. So I know that we need to provide value information, and sometimes, I'm saying sometimes, but I'll probably say most of the times, the clients push us for information. The clients want to know what we know. The clients say, oh, come on, it's not a rumor, come on, you have more information, because it's perfectly understandable that they know that we are on the market, that we have more relevant information than they do. But again, let's not go beyond the limit where we exaggerate, we create conditions here where we're not disclosing the accuracy of the information we got. If it is a rumor, remains a rumor. It doesn't become a rumor saying that I heard it from a very good source. It's still a rumor. So very important that, for instance, identify communications as opinions, clearly identify rumors, and of course exercise proper judgment when we discuss this kind of information. So let's not really communicate misleading and false information. These are the recommendations of the code. And then he goes from there talking about the way that we can share that information. Recorded message, recorded phones. Again, it might seem obvious for some markets, for the banks, for market participants, but for some market participants, for some markets, this is not that obvious. So we really need to use methods of communication that allow traceability, auditing, record keeping, and access control. It's really, really important to protect that confidential information. And of course, the recording is highly recommended. This is when we share this kind of information about flows of the market, but also as well when we are sharing information about the general state of the market. And this we go into the market caller. So when we have a communication of market caller, please, let's always treat that communication to aggregate it and anonymize the information without saying that that customer in the middle of the country that normally trades that currency pair has been in the market again. Let's not infer or let anyone infer who is the customer, that the amount is significant. That's why we're probably discussing, because we never discuss small clients with other banks or with other clients. So aggregated and anonymized. Don't specify client or counterparty details, even locations. That is not really recommended by the effects of a code. This really information should be restricted to aggregated, anonymized information, so that we don't change or we don't give potential hints for information on patterns, on currencies, on prices, and even on times of execution. So this is something that the effects of a code recommends. Again, and I know that sometimes it's difficult to put this in practice, but the whole question is that we need to continue talking to clients, but we can't be talking to clients in a way that we unprotect confidential information, which will really limit the access to it and protect it. The example on WhatsApp, it happened a couple of years ago, and it was not only in the United States, but the United States was probably the first market to find some banks because of sharing information, sensitive information on WhatsApp. In the end, the Security and Exchange Commission and the CFTC banned fined some of the banks for using these messaging platforms. Of course, they were using the regular WhatsApp. Doesn't mean that the encrypted WhatsApp or the business WhatsApp is much, much better, because again, it's not a proprietary tool used by the bank, but it can be approved, provided, of course, that you have all the guidelines and all the controls established by your compliance risk technology department, in this case, that you can use WhatsApp. But most generally, WhatsApp cannot and should not be used. So some of the offenders was actually the persons that were heads of the desk, senior management responsibility, and they were the ones doing the inappropriate sharing. This caused some fines to the banks, but also caused some of the traders to be dismissed. So this is a particular sensitive issue. Do not use inappropriate methods for communicating, even though it's easy. And I mentioned yesterday to your group that I knew that someone told me once that, I use WhatsApp. I have it because now we have it in the computer, and I use WhatsApp because I communicate with my back office through WhatsApp. Most of my clients don't have Bloomberg. They communicate via Bloomberg, via WhatsApp as well. And then, of course, if I use WhatsApp to communicate with back office with clients, why can't I communicate also with other market counterparties? Well, It's not the kind of easy. It's probably now put everything in WhatsApp. It's easy. And the computer, you don't even have to go to the phone. But let's not go for what it's easy. Let's go for it's correct. Do not share. You can use WhatsApp for personal purposes. But giving information and also trading on WhatsApp, it's not really a recommended good market practice because it's open and you're not protecting confidential information. Regardless of the impacts that, of course, this happened for these persons. It's really not an appropriate, not an appropriate way to share. And if you go here on the principle 23 on the code, that's really clearly says, communication should be through approved methods of communication that allow for traceability, auditing, record keeping, and control. And also as well, recommended that communication channels on sales and trading desks be recorded. This is not only recording of the phone. Nowadays, a lot of us communicate through electronic platforms, inclusive with clients. But get one that, or use one that protects confidential information. The code also mentions, of course, that in some situations, we might use unrecorded lines. And we'll cover that when we go into the compliance risk on the next section. But of course, the usage of unrecorded lines needs to be under exceptional circumstances. And when those exceptional circumstances happen, they might be subject, and they need to be subject to a pre-agreement that that person can use, for instance, a phone outside the office or outside office working hours. So, but there needs to be a permission. There needs to be a permission when those cases exist. But the general stance is everything on recorded lines, but there might be a chance to do, or there might be a way to do unrecorded, but of course it's subject to permission to specific persons. So let's go then to the information sharing. Which of the following is correct regarding the disclosure of a full amount on a transaction requested by a client to a bank? We covered this. Remember what I mentioned this morning. What is correct? The client always needs to disclose it, may decline to disclose it, or should always disclose it in case it is requested by the bank. Do you remember what I mentioned? What do you think? It's 1, 2, or 3? Another answer? The code it's not one for one reason, but thank you anyway. The code is voluntary, right? So if the code is voluntary, it cannot oblige that the client should always disclose it if it is requested by a bank. And the client always needs to disclose it. If full amount, if this kind of thing would be on a regulation, then of course he would need to disclose it. In this case, the right answer is the client may need to disclose it. But it doesn't really help the market. The client really should be encouraged to disclose it and state the truth. Remember, state the truth. It's not just to disclose the full amount, but the client, if it is doing 20 million, should disclose it, and it really should be doing 20 million. It's not a question of disclosing 20 million to the other 4 banks disclosing another 20 million. If anyone knows, then he's probably trying to trade 100 million in total. So, should always disclose it, but also disclose, state the truth. But if the clients want, and this the code allows, the client may decline to disclose it. But then it doesn't help the client, as I mentioned this morning, because then we will price it, probably inferring that the client is not going to do only with us. Let's see, for instance, oh, I'm not the main relationship bank of the client. So if he's asking for me for 20 million, most likely, he's probably asking the main relationship bank for another 20 million. Last week, the client actually dealt 60 million. Maybe this time he's dealing another 60 million. So we might start thinking and show a price to the client that might not reflect it. So the client, if he's stating the truth but doesn't want to disclose it, maybe he will get a worse price for the 20 million than he should. So the client should always disclose it, but of course, if it is true. If the client discloses it and say, no, it's not a full amount, then we are out in the open. The client should know that he will get a worse price than if he has disclosed it, that it is a full amount. So it's really not just for us to get confidential information as banks. It's really to protect the client and give him a better price. The responsibility for increasing the transparency of the market is not just for the banks, it's also for the client. And this is a clear way where both of them can increase the transparency. Which of the following is an appropriate way to share market color? Disclose the flows by exact rates, by price range, or refer to the time of execution? What do you think? Shall we disclose time of execution? That's too confidential information, right? We should not disclose time of execution. And also, we should not disclose the exact prices that were done. That's confidential information. It is okay if we disclose the range. But of course, it's normal and it's advisable that we disclose a real range. If the market has traded between, let's say, 20.50 during the day, let's not disclose a range and say it's 10.90. No. Let's help whoever we're passing that information to other clients, to other market counterparties, in a reasonable manner, but not the exact price that was dealt. Again, the judgment. If the market has gone in 20 and 50 and the client, let's say, we know that the client has done 25, maybe we can say it was done between 20-30. That's a way to see that the client actually dealt at a price closer to the lower range of the market. But we're not disclosing the exact price. Remember, we should really help the clients to transact with transparency, but without going into the detail of disclosing specific information about another transaction. So the price range is the one that is applicable here. Name a way in which entities may limit access to and protect confidential information. So prime brokers should appropriately separate their prime brokerage business from other sales and trading businesses, or confidential information obtained from a client can be used for any purposes, or market participants may disclose confidential information to the internal parties under any circumstances. What do you believe is the correct one? How can we limit access to and protect confidential information? Okay, let me try the tables. Can this table tell me 1, 2, or 3? Any guesses? What do you think? Don't mind if you don't get it correct. Don't problem. It's just for us to discuss. 1, 2, or 3? 2, 3? You mentioned 3? So, okay, so let's go and cover. 3 is not the correct one. Why? Internal parties. And sometimes we might have to disclose information to internal parties, but there needs to be an argument, a valid reason to disclose it to internal parties. We mentioned before that I was talking about policy, legal, risk, compliance, but only for those ones. So there are always as well exceptions. So we cannot disclose it internal under any circumstances. There needs to be a valid reason to disclose it. And it could be, again, for legal purposes, compliance purposes, risk purposes, policy purposes. So 3 is not correct. Are we okay to select 2? Any purposes? Not really, right? So it is the first one, prime brokers. Prime brokers represent normally hedge funds that don't want to trade directly in the market. They want to trade with protection of their identity. So prime brokers deal on their behalf, but they are not intermediaries. They actually take on the shoes of those clients. whatever we do with a prime broker, if a bank has a prime brokerage business, it should be totally separated from the normal business that it's done by the clients. It really should be treated as two different departments with appropriate segregation. That is the right way to limit access and protect confidential information. It is separating the prime brokerage business to the traditional business of the bank, sales and trading. Okay? Applicable law relevant for the disclosure of confidential information? What do you think? I think we can scrap the first one, right? Because we mentioned this morning, it's not a not relevant at law because the effects of a code supplements applicable law. We talked about it, it's not supplementing. Effects of a code complements applicable law. For the disclosure of confidential information, can we do it but only when it's related to an order? Remember the exceptional circumstances that we can share confidential information. If it is required to be publicly disclosed under applicable law externally, we need to do that because we are bound by the law. So it's not conditioned to a client order. Okay, so whatever the law says that we have to do, we do it, even sharing confidential information externally, but only if it's required by applicable law. Why should market participants avoid using ambiguous terms in their communications? What is the rationale? What is the correct answer there? One, two, or three? Shall I go to the other table? Can I go to that third table here? What do you think? 1, 2, or 3? 2? I heard it from here. Well, I'll come back to you later. Okay, so ambiguous terms in communication not relevant for the standardization of disclosure templates. It's not really because it's the law that obliges. No, it's a recommendation of the code which should really avoid using ambiguous terms. It's not just because required by law. We should really use clear and concise terms to communicate with market participants. So it is the second because communication should be easily understood. It's not because we are required by law. This is a good market practice that we should apply all the time, regardless of the law that is applicable. In which way can the timely dissemination of market color contribute to an efficient, open, and transparent market? We mentioned this, right, already. What do you think? 1, 2, or 3? We referenced the execution time. I think we already agreed that that's not something that we should share, right? Free disclosure of individual trading positions? That shouldn't really be correct. Correct, right? Yeah? You all agree it's 1? We mentioned that, right? On market color, it's always anonymized, and aggregated flow information on the general state of the market. Not specific information about prices, about time of execution, about clients, about their location, about amounts. No. Just really anonymized and aggregated information. Sorry. Which of the following statements is incorrect regarding market color? We should not solicit confidential information. We should solicit confidential information, or we should really restrict to sharing market views and levels of conviction. This one is what is incorrect. 2 of them are correct. Which one is incorrect? Can I have feedback from that table? What do you think? 1, 2, or 3? Which one is incorrect? Which one, sorry? 2, perfect. Yes, that's it, right. The one that is incorrect is that we can never ask for confidential information in the course of providing or receiving market color. We should actually limit access to it, but not request for that. Thank you. Under which specific circumstances can confidential information be disclosed to a market participant to external parties? Remember, we had 6 circumstances. Any point in time, never we can exclude if we have 6 circumstances because they are allowed. But any point in time, or for instance, to a broker when a transaction is being novated. The answer is in the question, right? If there are exceptional circumstances, they are allowed, but it's not at any point in time, right? So it's number 2. When a broker, for instance, for a transaction being novated or amended or cancellation, to a broker or to another counterparty. Which of the following is recommended by the code with regards to rumors? We are absolutely forbidden to spread rumors. We are free to spread rumors when they intend to benefit the client, or we should exercise judgment when discussing rumors. 1, 2, or 3? Can I have that table at the end? 1, 2, or 3? What do you think? 1? Perfect. Thank you very much. So it's not forbidden to spread rumors as long, and the code does not forbid, again, it's a voluntary adherence code, so it's not a regulation, but we shouldn't really spread rumors without qualifying that there are rumors. We are okay to share rumors if we qualify them as rumors. And the intention of spreading rumors is not to benefit the client, it's to give information to the client. The rumor might be against his intentions or might be against his interest in the market. We should not give rumors only when we think that that rumor is to benefit the client. The client is asking us for information. So judgment, and that's what we always talk. Judgment, very, very important when we are discussing rumors, particularly the ones that may drive movements in the price. Okay, and the last one for information sharing. Which of the following is a good market practice for an anonymous trading platform? What do you think on this one? We go in, I'll cover this. So, it should not really be relevant to say if a real counterparty to a trade is under the scope of applicable law. Why? If we are trading in the market, we should know applicable law. That comes in various areas of the code. So if we know applicable law, we should know if that trading platform or the other counterparties that will be within the trading platform are bound by that applicable law. We have the list of market participants, the types, and we can ask the trading platform, of course, what are the types of customers or clients that they have on that. It's not putting the responsibility on the anonymous trading platform to understand if that is counterparty is in scope of the law. We should know that by heart. Inform users if a potential counterparty to a trade has signed a statement of commitment. No, it doesn't need to be only when there is a counterparty to trade and only inform users there. No, what anonymous e-trading platforms have a responsibility is that in order to promote that a lot of their liquidity providers have signed the statement of commitment and therefore it is admitted that they've already set up the FXable code in their practices, that they should inform all users that the counterparty to a trade has signed the statement of commitment. So it is a recommendation for those anonymous trading platforms. It's not a specific recommendation for the single dealer platforms, because of course if it is a single dealer, if we go and have a platform with Deutsche Bank, for instance, it's easy for us to know if Deutsche Bank has signed the FXable code. But when they are coming via an anonymous e-trading platform, the responsibility of the platform is to inform all users that the counterparty to the trade has signed the statement of commitment. But not only if they want to trade. It should be part of the information, the disclosures of that trading platform. Okay, perfect. Thank you very much. Before we go to risk management and compliance, any questions on information sharing? No? Okay, so let's go ahead. Risk management and compliance. The largest area of the code, 18 principles. The first ones, they talk about those frameworks that we mentioned. Risk management, compliance, and review. And the last ones will talk about the key risk type. There was a change here at principle 35, and this is where we will cover more on this part. So, important thing here in terms of the frameworks, the first part of risk management and compliance is, as I mentioned before, risk management function, compliance function, and audit function. The components of these frameworks are really the base is on the governance part that we saw, those 4 principles, and now we go deeper and check what are the details of those frameworks or what those frameworks should contain. Before we go into that and see the purpose of those frameworks, it is important that the components of all of them are senior management or senior body oversight. They really need to be responsible for not only putting in place these frameworks, but also monitoring their implementation and their efficiency. But of course, in order to do that, they really need concise, timely, and very accurate information. And those frameworks should have something that we mentioned before, the segregation of the 3 duties. What is trading, sales, front office, what is risk management, and what is the operations, middle and back office. So really important that you have a segregation of duties between these 3 areas. So these are the components: management oversight, supported by the information, and installing these duties within those frameworks is very important. Why do they serve? So that we can identify and understand the various types of risks by being involved in the FX market. And then, of course, by identifying and understanding, we can limit, monitor, and control those risks that are applicable to the trading activity of our entity in the FX market. So that is really the base for these frameworks to allow us to better control, limit, monitor the risks of our activity in the FX market. So I just have here the components of those 3 frameworks. Again, reporting lines, independency, segregation of duties, all of that in there. This really, when we're talking about compliance, risk management, and audit, really mirrors what's in the Basel Accords for a higher or increased or enhanced responsibility from those 3 key areas in providing a very good way for any entity to control the risk, or initially to identify and understand the risks of an activity in the market, and then to manage those risks effectively. So these are the components of the compliance framework. Then we go into the components of the risk management framework, with if there is a problem with incorrections, independent valuations, reporting, so we might have escalation procedures to allow senior management to detect if there are some circumstances where we can reduce the limits, maybe we can extinguish or reduce the relationship with one counterparty that is causing us problems not only in terms of the risk, but in terms of bad settlement, bad confirmation, but we'll cover that a little bit later. So the idea here is that those escalation procedures would probably help the senior management to decide what to do with that particular instance, with that particular potential malpractice. And then finally, the audit review as well. Very, very important that the audit review also needs to monitor the efficiency of the compliance and risk management functions. But again, independency, segregation of duties, very, very important. All of these, the components of these frameworks to allow us to go then into have the identification, understanding, and then limiting, monitoring, and controlling the 7 risk types. Credit counterparts, market, which includes liquidity risk, operational risk, technology risk, settlement, this is the one where Principle 35 was changed, compliance risk, and legal risk. In this area of the code also you have a small chapter there about the prime brokerage activity. That's Principle 41, that we'll see that in a minute as well. So 7 risk types, again, identifying, understanding them, and then controlling them, monitoring and then controlling. The only change here was on Principle 35. So again, this is about the credit and counterparty risk. We're talking about it's good to have netting and collateral arrangements, but we mentioned this in the past. It doesn't go as far as saying that it's ISDA CSA, because in some countries, ISDA and CSA, it's not applicable. So it would reduce the application of the code. If a particular country cannot enforce legally the ISDA and CSA, you can use other applicable documents that more or less do the same thing as the CSA and the ISDA, which is valid for a particular jurisdiction. Then when we go into market risk, as I mentioned, liquidity risk, we talk a little bit about as well the potential usage of stress techniques to try to understand how can we measure risk in particular scenarios, like drastic scenarios. So we talk the whole word stress scenarios. Again, mirrors a lot what came up from the Basel Accords, and also as well with some additional guidance on the mark-to-market. We mentioned this on the execution part about how to use mark-to-market to evaluate transactions. And here, some more guidance on that. For instance, quoted market prices. You remember we mentioned this morning that pricing display platforms with indicative prices, they are not part of, they are not market participant, because we cannot use them for, it's just for information. But for mark-to-market, we cannot use them. We need to use platforms with tradable prices. Doesn't mean that we're going to trade, but at least we're doing the valuation with a correct price. And of course, as we mentioned before as well, front office does the transaction, but from then on, the valuation needs to be decided by an independent function. They might ask front office, what is their opinion? What is, in your opinion, the best? And now we're talking, there's a lot of companies that are providing benchmark services for various products on the FX market. Front office might have knowledge of those, but it's not front office that should check those valuations. It should be an independent function. Again, conflicts of interest. Remember Nick Leeson, as we mentioned before. You cannot trade and be the one providing valuations for the trades that you've done. Oops. So again, coming back to if you need to use external data for valuation, there's some guidance in the FX code on that. Only real and firm prices. You can use brokers, you can use other third-party providers. Again, screen service, but with real and firm prices. This is what we mentioned. Price displaying platforms are not valid. Must be checked by an independent function from front office, as we say here. When we go into operational risk, we're talking about any circumstances that can impact severely our trading activity, normal trading activity. And it could lead, for instance, like time differences because of cutoff times on payments, different industry conventions. Normally in Europe, everyone refers to Europe, this case, continental Europe. Normally everyone refers to the euro against the sterling. When we go to the UK, they normally talk about the sterling against the euro. And we all know it's not just an inversion, because if we restrict to 4 decimal points, sometimes the inversion doesn't give 4 decimal points. So different industry conventions. One other issue here happened, I think it was 2 years ago, when the Queen passed away. Unexpectedly, the day of the funeral, there was a holiday. So any trades that had the value date of that Monday, what are we going to do? Are we going to make the settlement on Tuesday, or are we going to go back to the Friday? So sometimes these kind of situations occur. In the Middle East, for instance, there's still some holidays that are subject to the lunar calendar as well. So we only know them a few weeks in advance. We need to take care of all of this. But of course, as we're talking here about operational risk, big part of this area in the code talks about the contingency procedures, the business continuity plans. Some recommendations as well that, okay, we have a trading office in one location, we have a backup site, smaller, only for critical functions, not everyone should go there, but do not have the same network, because if the network in the principal office has failed, most likely the other office is not working as well. So some additional contingency procedures that we should have in order to, at least when there is a system, a problem that impacts your traditional trading room, you should continue at least with some critical activity until the problem has been solved. This is absolutely normal nowadays. Technology risk, we're very, very much dependent on technology. And so these principles on the code talk a little bit about the constant review of the systems, that we really need to periodically review, update, and test the system. Not only all systems in the front office, all the systems in the bank that are used to execute and settle FX transactions. So this is something that, of course, not only with the care with cybersecurity, but everything that impacts the normal development and normal functioning of those systems. Settlement risk, the one that we have changed. So when we had the beginning, when the FX over code was launched, PVP as the best way to settle FX transaction was always there. But there was a need, particularly in this recent version of the codes, to heighten or to make stronger language, because, as I mentioned to you earlier, settlement risk has been growing, and we really need to adopt many ways to control or even eliminate settlement risk. So what the Global FX Committee did with this version of the code was to introduce what they call a risk waterfall approach that gives any entity in any market the possibility to have a layer, hierarchical method of reducing or potentially even eliminating settlement risk. And this is what they brought, because not everyone can use PVP. It's not available for all the currencies. So basically what they said was that, okay, let's bring that and let's clarify that PVP, if it's not used, there are other, probably not as efficient as PVP, but other ways to reduce settlement risk. And this is why they brought the risk waterfall approach. So this is what they brought as changes to Principle 35. So risk waterfall approach, also promote consistent usage of agreed settlement methods. Also as well to make clear that all market participants have a responsibility for reducing settlement risk. And also as well, they detected that there was a need to reinforce the training for staff members on how to manage settlement risk. So before there was actually a reference to high-level understanding By personnel, no. Now it's management and personnel should have a thorough understanding. So there was, in the information that was discussed in several meetings, it was actually that it was referred as something that needs to be constant or needs to be focused in terms of more training for staff members to manage settlement risk. And let's see that risk waterfall approach. So the best way is identified. It was there in the code since the beginning, since May 27. PVP. Payment versus payment is the best way to reduce or even potentially eliminate settlement risk. But what if we cannot use PVP? Let's go then to the second best methodology. Let's eliminate it. But what if we cannot eliminate it? Then let's reduce the size and duration of that risk as much as practicable. What if we cannot do it? Well, let's then use it, and it's a way to do it, because this is something that we can all do it. How can we reduce the size and duration of that risk? Very simple. I know that sometimes it's difficult to put in practice, particularly if we have other procedures in hand. But we can, for instance, use automated netting systems, bilateral or multilateral. Let's go for bilateral and multilateral netting. If you do several transactions amongst yourselves, do not do, and that is the one that is discussed, do not perform gross bilateral settlement. If you have 10 transactions in the same currency pair during the day, work on the reconciliation, and at the end of the day, only make one payment in one currency and receive one payment in the other currency. If there's no zero amount, or just for the PLR, if there's still an open position. So let's try to reduce gross bilateral settlement. Gross bilateral settlement, we're talking about one or two settlements in this case, because we're talking about two currencies, one in and one out, on every transaction. This should really be minimized. So there are ways for us to reduce the size of duration. And as you know, this is gross bilateral settlement. Until a few years ago, this was traditional. But now, let's go and try to do bilateral, multilateral. If you can do it via automated netting systems, much better. If you cannot do it, but still do it manually, but do bilateral and multilateral netting. Do that netting, because that's a good way. But anyway, 5 guidelines of what we should do. If you can do PVP, much better, but not all the currencies are applicable or eligible for PVP. So risk waterfall approach. I had a question on a webinar that we presented to one of our associations in Africa. They said to me when I introduced it, oh yeah, so this is only for the big markets. No, any market can apply. Any market can apply. If you don't use PVP, eliminate. If you cannot eliminate it, reduce the size and duration. How do you reduce the size and duration? Go and do bilateral, multilateral netting. If you don't do automatic, do manual, but reduce by a gross bilateral settlement. That is really what should be reduced. If we do this, settlement risk will stop growing and will start reducing. So main changes to principle 35. Moving on into compliance risk. So we're talking here about the recording of transactions, and recording of transactions also as well, and of course the appropriate storage and retention of those the transaction data, not only for us as market participants, regular market participants in the market, but also as well, the code also allows that if there is a request from a client, and again I mentioned, imagine that the client is going through a merger and acquisition, and the auditors or the lawyers that are working need to understand what the company that is being bought has been trading in the FX market. this is a valid reason for the client, in this case that it's being bought on that commercial transaction, to come to us and say, I really need information about the transaction. If the client comes to us with a valid reason for us to provide that information, we need to have the tools and the resources and retain the data with the level of detail to supply that information to the client. So it's not just for us, for reporting, or for the regulator. It's also as well to potentially provide clients in this kind of circumstances. When we go also as well on the compliance risk, we're also talking as well basically on the KYC. And the KYC, one very strong recommendation, is not just KYC when we open a relationship with the client. Because of the level of some of the clients, and we're talking clients, but we're also talking about market counterparties, we need to continue our vigilant mode in terms of whether the clients are not going into some illicit activities like money laundering, terrorist financing. So KYC checks should not be done only when we start the relationship. They should be done on a regular way. So it's really, really important that we do those KYC checks. Of course, understanding of applicable law, we mentioned this, that's quite relevant. If we need to apply regular training, in several markets, I'm not sure if it's the case here in Sri Lanka, but in several markets you do training every year. In my country, in Portugal, we do training every year, or everyone in the bank do training every year on money laundering, anti-money laundering, on anti-terrorist financing. So of course it's something that we need to do on a regular basis. Even if the regulation doesn't change, the market is changing all the time. Now we have a lot of, at least we've heard quite a lot of persons doing money laundering through crypto assets. And of course, crypto assets in dollars. Of course, if you're going to bring that into a country that doesn't have dollar dominations in their own country, if the dollar doesn't circulate normally, of course, you're going to have an FX transaction coming back from that. So we really need to be trained on a regular basis. Accurate and timely reporting of suspicious activities to senior management, potentially even to the regulator, again, to detect issues. And if we detect those issues, let's use the whistleblowing channels that we mentioned this morning, because we might need to investigate what's going on there. It's probably not helping the integrity of the market. Also as well, monitoring procedures for P&L. Of course, restricted trading access. Anyone can go into a dealing room, into a treasury, click the button or pick up a phone and do a transaction. That access should really be restricted. And as I mentioned to you before, when can we permit that unrecorded lines are used? For instance, if someone needs to trade after hours or off premises, those persons should be pre-allowed before going into trading, pre-allowed to have that on an unrecorded device. Or when we're talking unrecorded device, not only phone, even on messaging systems. And this is why the FXable code also, this is one of the reasons, not only the only one, why the FXable code recommends the existence of trader or dealer, trader-dealer or desk mandates. I'll now give you here just some examples of what can be a dealer mandate with some specificity, some features in there. The important thing here as well, coming back to the same point, but not related, but same point or same procedure that we should do. As I mentioned before, KYC checks should be regularly validated to make sure that they are still accurate. Dealer mandates should also be regularly checked to make sure it's not just signing a document when you join a bank and then putting on the shelf or in the folder for 2 or 3 years and not checking it again. Market is changing all the time, so let's make sure that we always check that the trader, in this case, if it is a dealer, is compliant with the mandate. And of course, get it signed by that person as well. If we go on to the legal risk, we talked about this, applicable law. The only additional point here is that we should really have, as we mentioned before, legal agreements with standard terms and conditions. Again, the code doesn't mention ISDA. But if you have an ISDA or if you have something similar applicable in your market, it is a good document. But sometimes there is a need for you to agree non-standard terms and conditions for particular transactions, or if you're going for some other asset classes where there might be an FX component. So you can go there, and the code recommends, but before you agree to any transaction, you should have those non-standard terms and conditions agreed between you and the other counterparty, or between you and the client before the transaction takes place. Not agree afterwards. So stick to the standard terms and conditions, but if you need to go to non-standard terms and conditions, agree that before the transaction takes place. Then the final chapter, or the final principle in this area, which is for prime brokerage activities, basically is just to say that, as I mentioned, prime brokers, they really need to step on the shoes of their clients. They trade on behalf of their clients, but in their name, so they're not voice brokers. And of course, they really need to disclose to clients how to monitor the credit limits, how limit breaches are managed, and also as well that they need to act as a bank because they are servicing a client. The fact that the client, in this case, it's a counterparty, it's the same as if you were in a sales department. But remember what we mentioned before, segregation of duties. Whatever a prime broker does, you do not pass any information to the normal trading area of the bank. It could be a prime broker within the bank, but it needs to be completely separated to the trading area of the bank. And of course, not share information about activities of both of those areas. So I'll just go ahead. This is something that we mentioned last year about the KYC. There is something just here that we mentioned as well, which is basically on the KYC, really, it's there on the code. Make sure that transactions are not used to facilitate money laundering, terrorist financing, or the criminal activities. But in order to do that, of course, because there are changing methods of money laundering, and the code mentions that as well, do effective training. Do effective training, and effective training should really be provided for relevant personnel at all times, because they really need to make sure that relevant personnel is always attentive to the rapid changes of money laundering. And I'll give an example here that in a few slides. For instance, this is one entity that is inviting clients to trade for an exchange without KYC. How do they do that? You need to go into crypto first. You need to go, if you make money on FX, that money is always going to be translated not in real dollars, but in crypto, which of course is dominated in dollars. So you want to get risk, or you want to get exposure to FX, but you also get exposure onto crypto as well. And this is not the correct way, because you are circumventing what is a good market practice and inviting customers to say, yeah, trade and without KYC. So this is not a very good way, and it's actually branded as one of the most reputable brokerages. It's not. And of course, there are already cases of entities using money laundering or doing money laundering using crypto, as I mentioned before. So let's go to the risk management and compliance, and let's go and cover some of the questions. So, why are training and/or attestation process important on a robust compliance framework of a bank? They assist market participants on understanding the products that are sold, on advising which products might be sold, or they promote awareness of and compliance with applicable laws and standards. What do you think? 1, 2, or 3? 2. That was a quick one. Thank you. So, training and attestation process at a bank, when they are included in the compliance framework, they're not there to assist what products, shall we say, or advise what products might be sold. If you need that kind of training, it's not in a compliance framework. This is a commercial part. Go to the marketing or to human resources and get that training to learn how to sell the products. And normally when a bank develops a product, Normally, it always does a training session for everyone to understand how to sell it, but that's not part of a compliance framework. On a compliance framework should not relate it to the business anyway. Compliance framework is really just to promote awareness of and compliance with applicable laws and standards, which are the ones that we have to respect by having our office open. So this is two. The other ones might be relevant, but are not part of the compliance framework. Now, the risk waterfall approach. Rank from the best to the worst the methods for reducing settlement risk as introduced by the risk waterfall approach included in the code. What do you think? What is the best one there? All of those. Payment versus payment, right? PVP. So if the PVP is the best one, there's only one answer that says 1 as first, right? You all agree? The last one, or we can go by the one that has the last one, which is gross bilateral settlement. But then we have two options there. So first PVP, then net multilateral settlement, and then gross bilateral settlement. Okay. Which of the following is recommended as a minimum disclosure for an FX trading platform with multiple liquidity providers and consumers? Disclosure of the specific methodologies that are used to calculate credit exposure, disclosure that exclusive responsibility in credit limits breach falls to the users, or that responsibility in monitoring credit limits falls to the platform. Do you think that the exclusive responsibility in resolving and monitoring credit limits falls to the user and to the platform, or it should be a combined way? Again, coming back to what we're talking about, the responsibility of clients. Clients need to be responsible as well to monitor the credit limit and resolving the credit limit together with the platform. The fact that the platform might have the tools to investigate doesn't excuse the clients to giving all the responsibility to the platform. Okay, so it is really disclosure, and actually to help the clients, disclosure of the methodologies that are used to calculate credit exposure. It is a shared responsibility. Even if the client is not in the market every day and the platform is, the client also has responsibility to understand what are credit exposures and also to monitor them and to resolve them. It's not exclusive. It is to be shared by both of them. If I had here disclosure that the responsibility to resolve credit limits falls to the users, yes, as well, but it's not exclusive to the users. Must be both of them. But of course, they need to know what are the methodologies that are used to calculate credit exposure, and the client needs to understand them again, and they can do that, for instance, by adopting this, by adhering to the code. Hello? Sorry. Oh, okay. Which of the following is incorrect regarding market-to-market trading position? So, the users of quoted market price where available is generally the best guide. You all agree with that, right? Quoted market prices. The last one, a function independent of the front office should check that price evaluations are measured accurately and regularly. That is correct. It needs to be independent. Front office trades, but from then on it needs to be an independent function. So the incorrect one is the usage of indicative market prices. Remember, the pricing display platforms. There are few questions on the exams about the applicability of the pricing display platform. This is why we brought it this morning, and we're talking about this. They might give you relevant information, but for the purpose of the code, we should not use them. This is why they are not market participants, and they cannot be used for valuing transactions. The music is starting early today. Are they doing a pilot for tomorrow's? Name an inappropriate practice on limiting, monitoring, and controlling the risk of a market participant's trading activity in the FX market. Inappropriate. So 2 of them are correct in terms of practices. 1 is incorrect. Which one is incorrect there? I'll ask. I don't think have I asked for that table? No, please. Which of these you think are incorrect or is an incorrect practice? 1, 2, or 3? Perfect. Yeah. I saw late. It's 2. Why is 2 incorrect? Can someone tell me? Where is the independency, or sorry, the segregation of duties? Right? Valuations should not be done by functions or by roles or by persons that work at the same unit that owns the risk. The same thing as saying, if a front office did the trade, it cannot be the front office evaluating the trade that is done. It needs to be an independent function. So this is not appropriate. Is it acceptable for a risk management function to work closely with business units? So there are 2 yeses and 1 no. What do you think? 1? You think it's 1? Everyone agrees it's 1? No, the third one is incorrect. It is okay for them to work with the business units, but, and 1 is correct because of course they need to be independent and not directly involved in revenue generation. They can work with the business units, but should they not be impacted? We have a question on that later, which please remember this one because we can come back and we'll see whether you have the same answer. How should the effectiveness of the risk management compliance function be reviewed? Establishing reviews only for the issue that occurs, establishing processes that provide independent and regular review, or establishing processes that provide ad hoc review when issues occur. Which one? Ah, perfect. Sorry. Second one, right? Independent and regular reviews. Not only when the issues occur. If the issues occur, we are already in trouble, right? We should really try to have independent and regular reviews to try to detect the problems before they exist. And they need to be regular, not just ad hoc. Not appropriate for inclusion in an effective compliance framework of a market participant. Not appropriate. And this is a particular area of the code which is actually very, very curious, if we can say it like that. What do you think? This table, what do you think? Inappropriate. True? Yeah? Why is it inappropriate? Can't we waive our vacation periods? It's not a good market practice. We should always have our normal vacation periods, because if we depend too much of our work, if we depend and if we don't want to leave our work, it might lead to suspicions that we are doing some illicit activity. Vacation periods are important, and the FX Code mentions that it is important to consider measures of vacation periods, and even sometimes it doesn't go that far into saying that it's minimum 1 week or minimum 2, but it could say, it says that you should really have regular vacation periods and you should take them, regardless of course what is applicable in every country. Market participants should ensure that relevant personnel only need to comply with internal rules and procedures, highly remunerated, or relevant personnel that commits the market participant to a transaction has the necessary authority to do so. Do you all agree that it's one? I think we all agree that it's two, right? Highly remunerated. We wish, right? No, it is three. The FX Global Code doesn't say that. We do that, the second is true by our own merits, right? But that's not in the FX Global Code. So it is the third. We really need to have the authority to perform a transaction. Now, this one, let's see if we have the same answer. Should partial amounts of the trading area's bonus pools be used to pay the bonus of risk managers with roles in revenue generation activities? So if we have a risk manager that helps us to create more money, in the trading office or in the trading area, shall we share a part of the bonus pool to that risk manager? No, why not? Are you all okay that it's one? It's not even needs to be limited. No. A compensation structure, such one, would compromise the independence of risk managers. They need to be totally independent, and as we mentioned before, without any involvement in the revenue generation stage, and of course not being benefited by the bonus pools. If a bonus pool wants to be set for the risk management area, needs to be by the effectiveness of their work, cannot be connected with revenue generation, because they are not an area to generate revenues, an area to manage the risk. Okay, before we go to confirmation and settlement, any questions about risk management and compliance? No? Okay, so let's go, setting up the coffee, but let's go then just to cover some principles here on the confirmation and settlement before we do a quick break. Okay, confirmation and settlement, the last part of the code, 14 principles, and those 14 principles split in 4 areas. The overarching principles that really define how we should control and effectively implement these 4 processes for confirmation, netting, settlement, and account reconciliation as very important to support the effective settlement. So post-trade activities now, the last area of the code, before the annexes, of course. So the overarching principles talk about that very, very important. There needs to be a consistency with the operating practices that support these processes, with the documentation, not only for confirmation, but very important for confirmation, with any policies, for instance, credit and legal risks. So consistency between the operating practices, documentation, and any policies. And of course, it needs to ensure that all these processes are supported by the capability of the systems and out of those processes and out of the resources whenever we have normal and peak market conditions. So if there is a need to have robust systems to support all these post-trade processes, they need to be installed, regularly reviewed, and with some particular space if we go into a peak market condition. What can be a peak market condition? A higher number of transactions compared to the normal, which will result in a higher number of settlements, higher number of confirmations, more management, more frequent management of the account reconciliation. So we need to have systems to ensure that all these processes are okay for the current activity and for a higher level of activity, not only in terms of the number of transactions, but higher amounts and more volatility as well. So from then on, we go into the processes, which of course, a lot of them, it's a recommendation that it should be as much as possible automated. And then we go into here, into the netting and settlement, where we talk about the standard settlement instructions, and that was 2 changes to Principle 50 about settlement risk and 51 about SSIs. But let's look into them in more in more detail. So when we go into the overarching principles, we are assuming that this could be a normal processing or flow of a transaction. In some circumstances might change, but we need clearly to put the difference between the front, middle, and the back office. Remember, segregation of duties, independence, it's very, very important for the processing. And the FX subcode mentions as well that particularly the operations area, particularly the middle and back office, they need to have an understanding of the life cycle of every FX product. This is just a standard in terms of the processing of a transaction, but the life cycle of every FX trade can be a little bit different. So there must be staff, resources, personnel with clear knowledge of the various processes affecting the FX products. So then if we go into the overarching principles, of course, as I mentioned to you, that consistency between the operating practices, the documentation, and any policies that you might have. Might be credit, might be legal policies that support those operational procedures and the confirmation and the documentations. And of course, as we mentioned, technical and operational capability. As I mentioned before, it's not just the systems. Also, the resources need to be able to work when there is a need for higher capacity, be it for a number of transactions or that you need to work after hours if there is a particular event. So we need really to have that possibility for all market conditions. And of course, for that, we need also to define contingency issues. For instance, again, if there is something that we need, normally in the UK, the elections there are on a Thursday. If there is a need, normally when there are elections and they're very, very close to call, most of the banks work after hours. They will stay overnight until the results are known. Sometimes that happens. This is a particular example where you need to have a contingency mechanism for that particular night. And sometimes it can go into the morning of the next day. So again, you need to have that contingency plan connected with the BCP, but in this case to make sure that the post-trade processes, be it confirmation, netting, settlement, account reconciliation, they need to be performed. Extra capacity demands, as they call it. Of course, on that and overarching principles as well, they still, and they talk, it's very, very important, of course, the transmission of data where possible should be automated, but also as well, and talking again about the segregation of duties, a system on the front office register trades by the front office staff, a system in the back office receives the registry of the trades and takes care of the confirmation, settlement, netting, and account reconciliation. Account reconciliation, of course, needs to be managed by, in this case, by the money market desk or the front office. But in terms of the confirmation, netting, and settlement, they need to receive the information automatic, and the systems must communicate. We cannot have one system which supports front office and supports operations. The systems need to be different, but they need to communicate because the transaction is executed and registered in the front office, and then it gets sent to the processing area. What we mentioned before about novations, amendments, and cancellations, also it is referred here on this process about going into the principle because it affects not only the confirmations but also as well potential settlements if you have novations, amendments, and cancellations. And we need really to have a clear process. There might be credit risk as well, particularly on the novations, but also as well if you have amendments and cancellations, if you see that a lot of the counterparties that we trade, front office trades, oh, they're very, very good prices we trade. But if it goes to the post-trade, if you go to the operations area and you see frequent requests to amend transactions, to cancel transactions, it might bring a suspicion that something is not correct. And that market participant might be going into some kind of illicit activity and which not support or doesn't support the integrity of the market. So that's why as well that whenever you have novations, amendment, and cancellations, there needs to be a regular reporting to senior management. If there is one circumstance ad hoc on an occasional basis, that's fine. But if there is a repetition of instances, particularly with the same counterparty, you probably need to go and investigate and get senior management to try to understand. And if you see a problem occurring with that entity, maybe again you can come back. You should probably come back and think about reducing the activity or even canceling the relationship with that counterparty. But at least you need to have the regular reporting, of course, and it needs to be supported by the systems to do that. Yeah, sorry. Yeah.
With regard to this amendments and cancellation of deals, when you do a interbank transaction or like external party, yes, but like when it's been often mentioned, like highlighted about these things, like I'm from front office, like the other departments, audits and risk management people, like I think they overreact by seeing these things. Like even when a deal has been input to our own system and within 5 minutes it's cancelled due to a technical reason.
Yeah.
Even that is being considered, like I don't know, by most of the institutions, that is also being considered as one of the actual transaction cancellation.
Yeah. Yeah.
Which is, I don't know, they are not interpreting in that way, but they are interpreting in like
Yeah,
cancellation.
yeah,
It's
exactly, yeah, yeah. I can understand what they think,
put
yeah.
on management,
Yeah, I know, yeah.
committees and stuff
Yeah.
like that.
I think
So many deals have been cancelled, so many deals have been amended.
it's probably a natural reaction, right? But we need to understand, of course, that what are the reasons for that. If it is a technical glitch, if there is a problem, well, maybe then there needs to be an investigation why the system is allowing that technical glitch to happen, or the network or something like that. But I can understand their part, that when they see it, and if they see it happening many times, they think, oh, okay, there's a problem. But this is where the communication is very, very important, to make sure that, okay, this was a technical glitch. The problem is when there isn't a technical glitch and there is a real problem. And this is probably why they get a little bit alerted. Yeah. Yeah. But I can understand what you mentioned. Yeah. Yeah. But again, in the end of the day, senior manager will decide, and of course, they might request information from both of the areas involved to say, okay, was this really a technical glitch? Or if there, let's say, if there is a technical glitch, but always with the same counterparty, maybe there isn't a technical glitch, right? There might be a problem here. Okay, then if we go into the confirmation process, again, segregation. And here is important, not only segregation between trading or sales and operations personnel, but even within operations personnel, there should be segregation as well, coming back to the part of confirmation and also to the part of settlements. One thing very, very important there, again, we're talking about, the code doesn't mention SWIFT, but it's probably in the thinking of the wording of the code that SWIFT is an automated trade confirmation matching system. It is good. So whenever practical, use automated trade confirmation matching systems. But if you need to do manual confirmations, of course you can do them, but higher levels of control and policies to control the risks of doing manual confirmations. One way or another, email confirmations are not encouraged. I'm sure that all of you, or most of you, have already received confirmations from, even sometimes if it's not a confirmation of a transaction, but some sensitive information being provided by another entity, by another bank, where you need to go into, it's encrypted, you cannot see it on your mobile, you need to go and create a password so that you can see the message, and you respond to the message on their website for that particular purpose. It's a drag. Sometimes it's not really that good because you don't see it quickly. You need to open it to remember the password. But it is there for a reason, because that information is protected. It's not live on an email, and we all know that anyone can access email and there's a lot of phishing and all of that. So the idea here is that let's use automated trade confirmation matching system, reduce the manual part. If you need to use email, use the encrypted emails that your entity could have in place. Still on the confirmation process, it's very, very important. We mentioned this morning about the block transactions. I mentioned that if you manage a fund and you want to trade 1 million with the bank, but you have 10 funds there and each of them have 100,000, deal 1 million with the bank, but when you go and execute the registry of those transactions, do it as quickly as possible for the 10 transactions of each of them 100,000. So run your market risk first, but do not delay in inputting the respective transactions that were included on that 1 million. And of course, that would allow as well not just the correct booking and the book to be impacted, the trading book, but also as well the confirmations to go out as early as possible. So again, on confirmation process, if you have discrepancies as well, not just when we're talking about discrepancies on trades, it's not just on the rate of the trade, it's not just on the amount or potential counterparty value date. You might have discrepancies that are only noted at the confirmation part. Again, escalation procedures, because you might detect some repetition of some instances as well. And if you have that repetition, again, you might start restricting activity with those entities that are not aligned with best practices. If there is a frequency of entities not really understanding and not really complying with the agreement in terms of the transaction reflected here in the confirmation, it might lead you to think that something is a little bit problematic there. So again, the escalation procedures to senior management, and if needed, you need to resolve this issue internally, but of course you might report it externally as well. So again, regular information to senior management. This is what I mentioned before. Everyone in the back office or the back office should have resources to understand the life cycles of every FX product. So we all need to understand, if you are in an operations area, that some FX products have different life cycles within them. So now let's go to the netting and settlement process, and you'll see here, we'll see the changes on Principle 50 and Principle 51, but you will see here that some of this wording came up on Principle 35. Principle 35, we talked about settlement, but in terms of settlement risk, how we should eliminate. You remember the risk waterfall approach. Here we're talking about the effective settlement process, the methodology for settlement. And the FX Overcode brings some of the messages, let's say, here as well. You remember bilateral, multilateral netting, not gross bilateral settlement. Bilateral, multilateral netting is encouraged. It is encouraged as well market participants to implement payment date netting in respect of the settlement of their FX transactions. And of course, they should measure, monitor, and control settlement risk, but also, and because of the growth in settlement risk, we should really measure, monitor, and control equivalently to other counterparty credit exposures of similar size and duration. It's really, really a relevant risk to be controlled, and again, we need to stop that evolution and then start to reduce. And of course, then the mention about PVP as the best recommended way to reduce or potentially eliminate settlement risk. When we go in this area as well, we talk about the SSIs, and here's the segregation as well. SSIs, you should have segregation from trading and front office to operations, but also within operations, you should have segregation from the personnel that manage the SSIs, from the personnel that actually does the transaction in the currency accounts that are reflected in the SSI. So the management is not the person, or the person that manages the SSI is not the person that does the settlement. Cannot really be. There must be separate or segregation of duties even within the same department here. We had an example a few years ago in India where someone on the operations department took possession of 2 computers from 2 juniors. One computer was used to create SSIs, and the other one then, when this vice president sent the juniors to an early lunch, he took possession of the 2 computers, the one that he created the SSIs, and the other one then to make a transaction or transfer to him of about $5.4 million because he had some debts on online gambling. So even within a very recognizable bank, but through their branch in India. Of course, we need to have, again, the segregation of duties that I just mentioned, even within the same department. And of course, taking advantage of the computers of some juniors, it's not really a valid way. So what is the problem there? You're coming down to the judgment of 2, or in this case 3 individuals. But there should be other processes for not allowing anyone to take possession of the computer of a colleague. This part also talks about third-party payments. They are not really recommended, but again, the code doesn't prohibit because it has voluntary adherence, but doesn't recommend it because third-party payments can be connected to money laundering and terrorist financing. So the code says that if you need to do payment to a third party, have more controls because the risks are higher. That's basically what the code says. It doesn't say that you should stop them. It says that they are not encouraged. Direct payments are encouraged. But if you need to have third-party payments, put some excessive or some additional controls too, because you might have some excessive risks. And of course, if you have third-party payments, arrange them, agree them with the counterparty that wants to have that third-party payment before trading, not after trading. So going into the netting part here, and of course to allow for an efficient settlement, it is important that the management of the funding within the currencies that you trade on the FX market, they need to be managed on a regular basis. No one is telling you, of course, that in every currency you have exposure, that you need to have a minimum amount of X millions of that currency. No. But you need to have really is a process clearly defined that if you need to have a certain amount in that currency by the time of a value date of a transaction, you need to have the capacity to make that settlement. So no one is asking, and we all know that cost of capital today is very, very high. No one is asking you to sit with $1 million in every account that you have in order to provide for settlement. No, you need is to have the methodology, or you need to have methodologies to ensure that the efficient settlement, and you have resources to go and get that amount should you need it for processing that particular settlement. So look at your funding needs, but not only today's funding needs, but also always look at that on a real-time basis and look at the actual cash flows that you have and the expected cash flow. And this is where then this principle will connect with the account reconciliation processes. And of course, you need to be having systems that support that account reconciliation process and the management of the funding of those accounts. The idea here is really what's there at the end, to reduce potential complications during the settlement processes. So it's very, very important that this is managed on a real-time basis as much as possible, and also projecting what might happen in the next few days when you have the value date of some particular transactions, or even if you anticipate some transactions. So the principles the changes to Principle 50, again, as I mentioned to you, talk a little bit about the more or less in line with what we covered on Principle 35, but here in the process of settlement. We should really take care of FX settlement risk and consider that they are really to be treated in line with other credit risk exposure to the same counterparty. Simplify the language of the size and duration of settlement risk. Again, incentivize bilateral, multilateral netting. If it is automated, even better. But let's not go to gross bilateral settlement. And of course as well that we need to encourage market participants to implement appropriate compensation on the value date of their FX trades. But of course, this connects with what we just talked about the funding and the account reconciliation. And then it talks a little bit about the PVP. So some of this wording around this principle might look, and it looks similar to the Principle 35, but here again, it's to reinforce that it needs to be, this process needs to be put in place when we make the real settlement of the transaction, not just when we are reducing or trying to eliminate the risk of settlement. And then when we go to Principle 51, as I mentioned to you, so standard settlement instruction, that was just a clarity. The previous code mentioned standing. No, it is standard settlement instruction as the terminology widely used, but also says that the usage of multiple settlement instructions with the same counterparty, it's not really encouraged. So we should really have one set of SSIs, and this is why they're called standard settlement instructions. There might be some circumstances where you need an additional settlement instruction, particularly for a business area or for a particular situation, but they are not that encouraged that you should have multiple settlement instructions with the same counterparty. Have one and a standard set of SSIs. So there needs to be a clarification of what are the SSIs and these ad hoc settlement instructions. And these are really the changes on the code on 51. One is just the terminology, and the other one is to separate what is SSIs from the other ones, multiple settlement instruction, not the different settlement instructions. So, and finally, we go then into the account reconciliation process. Again, as we mentioned before, expected cash flows against actual cash flows. Why is that? In order to detect correct duplicate payments, incorrect amounts, or non-receipt or even late receipt of payments. So that is very, very important to help us out to make sure that the settlement is efficiently managed and is efficiently executed. So this is why we need this normal account reconciliation process. And of course, if there are issues with counterparties that frequently pay late, pay incorrect amounts, pay in double, maybe these counterparties might have some problem. And again, we might need to consider a limited relationship with those counterparties that cause problems not just for the operations department, but cause problems for all of us in the bank. And again, escalation procedures to resolve this. And if there is a need to identify settlement discrepancies, we can probably go and have compensation claims. So the code talks a little bit about compensation claims in a timely manner, but it might not be the best way to resolve a discrepancy. The best way to resolve a discrepancy might be, for instance, establish the value date. If there is a late payment, let's agree on the value date of the transaction, the initial transaction. If there is a compensation because it was paid 1 day late, both entities should agree what is the best way. Okay, so this is the main area of the code. I just have here a couple of examples before we go to the exercises about a particular entity in the UK that didn't follow any of these controls and they lost their licenses. Udita, do you want to do the small break now or we do it later? Yeah, because I'm just seeing, I'm not sure if there is something there, but or we do the exercises. It's up to you. It's up to you. 10 minutes? Yeah. Shall we do a break of 10 minutes? Then we cover the exercises. And then we'll see some just small things, and then we're going to cover the part of the exam. Okay, perfect. Okay. Shall we restart? Shall we restart? Mr. President? Mr. President? Okay, so let's restart. Let's go into the exercises of confirmation and settlement. Name which of these is a recommended best practice on the confirmation processes. Trades arranged via brokers should be exclusively confirmed by the broker. The usage of automated trade confirmation matching systems when available is strongly recommended. Or we should use specific and tailor-made message to confirm FX products. What do you think? 1, 2, or 3? 2. Yes, that's 2. Of course, the first one is not correct. We should not only have the broker to confirm it. And, of course, we should have standardized method types or message types. Even if, of course, if we're talking about the confirmation of FX swap, because we have 2 value dates, confirmation of FX forward has 1 value date. They are different, but the standard template of confirmation should be different. But of course, there might be items that differ. For instance, if you're trading an FX spot or if you're trading an option. But the message type should be standardized. Thank you. So go for question 2. In which of the following circumstances could the usage of multiple settlement instructions be accepted? In all of them, in no circumstances, or when there is a business reason for their usage. We said that they are not encouraged, right? So we should use standard settlement instructions. But they're not prohibited, right? They're not encouraged, but they're not prohibited. But of course, they shouldn't be in all circumstances. In all circumstances should be the SSIs. So sometimes when there are some particular situations, a business reason for their usage, we can use a multiple settlement instructions. But the standard should be, and this is there in the name, standard settlement instructions, they should be the ones always used, or used most of the times. I've opened the answer already. What is the appropriate procedure for when 2 banks choose to match their trades using front-end electronic dealing platforms? Let's go and look into all of them. The first one is the correct one because it says automated. This is the appropriate procedure. And it flows straight from the front end, and it's the front end that negotiates transactions, to the back office. The second one is not correct because it's the other way around. The trades are not registered in the operations department first. They are operations that they are registered at the front office that executes the trades. So it cannot go vice versa. And the last one, it cannot go vice versa, and they should not really be manual. If you can have, and that is the appropriate procedure, is to have the automated part, and always from the point where the trade is dealt, is executed, register, and then it goes into the back office for post or middle or back office for the operations department to be processed in settlement and confirmed. Market participants should establish consistency. We saw that at the beginning, the operating practices. So only between the policies for credit risk and the policies for managing legal risk, only between the documentation and the policy for managing risk, or between the operating practices, documentation, and policies for managing credit and legal risk. What are, I was going to say, the number of components. What is the correct one? Do you remember? There were 3 components there: operating practices, documentation, and the policies. So it should be the last one. It's not just the first one. It's not just the policies. Where are the operating practices and the documentation? So it's a combination of those 3. And they need to be consistent, and of course, then they need also then to be robust enough and have systems that manage the capacity in terms of technology and in terms of the operational resources in order for that consistent to be always maintained. Because the confirmation, account reconciliation, netting, and settlement process all depend on this framework. Which of the following is correct regarding capacity and performance management processes? No need to review them regularly, only when capacity at its peak. They should be documented and reviewed regularly, including with external vendors, or only to external vendors. What do you think? I think we're all okay that one is not applicable, right? Because it's not just when there is capacity at peak. No, we need to measure them all the time. So let's go into the vendors. It's only applicable to the vendors or with the vendors, meaning that our internal systems also need to be reviewed, their capacity and their performance. Yeah? Everyone agrees with 2? Including the external vendors, but that does not include ours. Yes, it is 2. Which process should provide for the maintenance of appropriate segregation between operations and sales and trading personnel? All these 3, or just cancellation, or just amendment? We mentioned this as well, right? All of those are applicable, right? Segregation, novations, amendments, and cancellations. And or, of course, but including the 3. Sorry, just being very quick. Which of the following is correct regarding block transactions? Remember transactions that are done, like the one I mentioned about a fund. 1 million is executed, but there are 10 funds, each of 100,000. So what the following is correct? After execution, they need to be subsequently allocated to specific underlying counterparties, booked as quickly as possible, and confirmed. From the moment they are booked, they need to be confirmed as soon as possible. They must be undertaken by market participants acting as principals. No, there is not a must. No, it actually can be an agent as well. And counterparties to these transactions can be approved after the execution. No. Even though the transaction was done with the manager or the asset manager or the fund manager, we need to have the counterparties, the individual funds, pre-approved before we can even book a transaction. It's not after. If there is no, and the example I gave, if 2 of those 10 are funds that we do not have open, and we can only open with KYC properly checked and validated, we cannot make a transaction for those 2. So the asset manager or the fund manager in this case should know that, should not have requested us an amount for 1 million, because 2 of them are not open as counterparties for us. So dual responsibility here. Again, a point. Clients need to know what they should request. They should adhere to the code, and knowing that trying to open or trying to trade with counterparties that they manage without those counterparties being open at KYC at our bank, that is not a good market practice. Which of the following is correct regarding confirmation and settlement discrepancies? Primarily, they should be investigated by the front office. They should be investigated internally and the counterparty should be informed, or they should be investigated internally with no need to inform the counterparty. 2? Yeah, everyone agrees? When, it is 2, thank you very much. So, of course, front office should not investigate them. They might be the ones detecting the discrepancy, if it is related to a transaction or to the amount or value date. But after that, the investigation is to be done by the operations department with segregation of duties and independence. Now, the question here is this. We inform the counterparty of a discrepancy, but we don't need to, and that we are doing an investigation, but we do not need to keep the counterparty informed about the results and about the process of that investigation. So we need to inform the counterparty that we are investigating, but we don't need to share confidential information on how we are investigating, okay? Because the error might be at our end, at the bank. We don't need to disclose that to the counterparty. Let's say, oh, the trader made a mistake. He booked an incorrect figure or an incorrect value or incorrect amount. The trader understood 50 instead of 15. No. This is not relevant for the counterparty. The counterparty needs to know the result of that investigation, and then, of course, if there are discrepancies, let's go into agreeing a compensation claim or any other methodologies, but not the result of that or the details of that investigation. Which of the following should be the action of a market participant that fails to make a payment on an agreed value date? What do you think? The last one, obliged to pay compensation costs in a timely manner. We mentioned compensation costs or compensation claims might be a solution to resolve discrepancies such as this one. Fails to make a payment on an agreed value date, but it's not obliged, okay? Again, the code doesn't talk about obligations. The code is voluntary and talks about recommendations. This is not a good one, suggesting that a new trade is executed at the non-current market price. We mentioned this. All transactions, if there are transactions to solve this issue, they should not be dealt at a price which is not the current market price. So the idea here is that the best solution will be arrange for proper value to be applied. If there is a resulting compensation claim, the parties would agree on that. But there's no immediate obligation to pay that. It is a resource, not an obligation, the compensation claims. Banks are encouraged to have one default set for SSIs for trading into bank market and another default set of SSIs for trading in clients. Is this a correct approach? We talked about this, right? Everyone agrees that it's 2? We should not have 2 SSIs, one with clients and one for the interbank. We should have one set of SSIs. We can, as we saw in the previous exercise, use some multiple set instructions for particular situations if there is a business reason, but there's no obligation. Okay, I have 2 more here. Why is the usage of third-party payments not encouraged when 2 banks trade FX amongst themselves? Because there's a lot of administrative tasks on third-party payments, because these payments are only applicable when bank trade with clients. Sorry, missing the word when there. Or because these payments might expose all involved parties to fraudulent activities. 1, 2, or 3? it's not because it's administrative tasks, right? If there is a need to have administrative tasks to take care of this, no, that's not why it's not encouraged. It's not encouraged because these payments might expose all involved parties to fraudulent activities. We mentioned that, right? Third-party payments may be the root or the origin or even the cause of money laundering activities, terrorist financing activities. So they're not really encouraged. And the final one. Which of the following statements is correct regarding the account reconciliation process performed by a bank? It should be performed by personnel involved in the processing of transactions that would impact that account. It should be performed on a timely basis because it allows the detection of erroneous or missing entries, or it should only be performed not in a Nostro account, but in a Vostro account. What do you think? 2? Everyone agrees with 2? So the third is not correct. It's not a Vostro account. We are responsible for our accounts, not for the accounts of others. And of course, it cannot be the one because it's a conflict of interest. The person involved in the account reconciliation process should not be the person involved in the processing of transactions that would impact that account. So it is the 2. Thank you. Okay, so let's now look a little bit. Hi, Trimali. Hello. She's there already. Okay, so let's go in the conscious of time. So I want to cover, I do have a few things here that we talked about data transparency. I want to show you the 2 illustrative examples. Just go very quickly on them. The 2 illustrative examples that we mentioned that cover, the new ones that cover Principle 10. I would probably look at the part of pre-hedging. You have that on the deck. Please look into that. I think we covered the majority of that. And of course, you do talk a little bit there about our response to IOSCO. I want still to go into 2 or 3 topics on settlement risk because that's very, very important. And then I'll go straight into the part of the exam. I would like to ask you is how many of you didn't take any exam with us, even December or January this year? How many of you didn't take the exam? All of you took the exam. Oh, still a few of you that didn't take the exam. So we'll cover the exam in detail. Thank you for that. Okay, so let's just go and cover the principles on data transparency. And of course, then I said to you that we will see the liquidity provider cover sheets. The only thing I wanted to mention to you on that is that, sorry, let me just go and show them to you, which are, this is one example of a disclosure cover sheet for a bank. In this case, as you saw there, it's Deutsche Bank. Hopefully it will come up in any second now. So this is a disclosure cover sheets on a PDF file, which is the standard template, and you can go there, you can go there and you can talk a little bit or check, for instance, the scope. You can go in the disclosures. They act as a principal on a principle 8, not as an agent. Then you go there and you have the client interaction date on principle 9. You can go and check as well then the pre-hedging. You go into the last look as well. So you do have a lot of details. And of course, then you have the links to go and check what are their disclosures, what are their policies. So it's a very good template to help out when you are about to trade with this bank and comparing with the others. And I picked up as random, as an example. It was the first that came up. You go into the Global FX Committee website and you have the ones that have their the disclosure templates in there. This is the one for the liquidity provider, in this case a bank. I want to show you the one which is for the platforms. And in this case, I picked one which is from Euronext. It doesn't really allow us to see a lot, right? Because it is on a different template. But if of course you go there with the zoom And you see a little bit of blue there, which means links to their policies. So the way of seeing it's not that great, but it has a lot more detail. It is the detail for the platform, and these are the templates that were done. So you do have, for instance, you go there, and we can see if we do the zoom, last look policy, the link to the policy, the tag management policies in terms of the point of tag disclosure, primary disclosure documentation. So you do have a lot of information there. It's just the format is not so easy to see as the one for the liquidity providers, but the information, which is the most relevant information, is detailed in here. So this idea and all, this is the new template of the disclosure cover sheets, this one for the platform, again, that helps market participants to understand the policies and procedures that any counterparty would have on how they disclose all their information regarding their activities in the FX market. So you just see here the details of the liquidity provider and then going into the trading platform. But I'll supply those two for you as well to see. They are public, but I'll send them to you. I'll ask SLFA to send to you in the email. So I want to cover as well is this part, the principle 10. So you remember the 5 points that we mentioned about delegated execution, right? So a principal initiating a transaction needs to, or an order from a client, transaction needs to have a pre-agreed agreement. The principal doesn't have market risk or doesn't run market risk. There should be transparency of the costs and fees associated with that execution, with delegated execution. And the final point would be that the client would need to have the procedures or the possibility to evaluate the execution of that transaction. And then the code goes to support this new wording of Principle 10 and talks about here 2 principles. One is a good one and relates to delegated execution. And we can see those 5 topics. Acting on a principal role, has a written service agreement with the client, purchases rent to fund security purchase on behalf of its client, and applies a pre-agreed spread fee to the exchange rate transaction on the market. Pre-agreed spread fee, principal, markup. Market participant makes available information to assist the client to judge the quality of execution, including the time and date of the transaction, along with the market reference rate prevailing at the time where available. And then the conclusion is here on this situation that it doesn't specifically refer to the fees and costs, and it doesn't specifically refer to the part of running market risk, but under delegated execution, of course, it will not run market risk because we are referring to delegated execution. So it fulfills the criteria of Principle 10 because they initiate the trade on behalf of the client and there's a pre-agreed written agreement with the client. And of course, then we talk a little bit the applicable fees and commission. But this is a good example. Not so good example of delegated execution, which is this one. A client uses a chat electronic platform to leave a limit order with the bank. So now initiation of the transaction, of the desire for a transaction, is by the client. And there is no pre-existing agreement. And that agreement can actually have, on the previous example, can actually have disclosure around the fees and commissions. But the client is expecting the bank to adhere to that. But what the bank says is that, there's no, it's not in scope because there's no written agreement. If there wasn't a written agreement, maybe the bank would go ahead and do it. But still, in this case, it was not the bank that started the transaction. It was the client. So you go here and you see the combination of these, and the feedback for this is that it is the client and there's no agreement. So the bank cannot be expected to comply with the requirements for delegated execution because we are not satisfying all the conditions needed for delegated execution. So the code now, the illustrative examples present these two cases of delegated execution to understand exactly the criteria that are inherent in there. So again, you'll see this in the presentation, but you also see this because we'll send the changes to the code, and we track changes, and you'll see these two new principles there. So the pre-hedging one is the one I'll leave that to you, so you can go. This is a little bit, sorry, you would see here, this is one of the reports that we mentioned that is actually now mapped on the forward, includes this kind of this graph, or this graph in terms of where the pre-hedging runs, and also as well. Then we talk a little bit about the submission of our opinion to IOSCO when they send the consultation report. You'll see there what we think it was not a good definition. And you also mentioned as well the case of Mark Johnson that we supported. Important to say, Mark was not our member. The bank was not our member at the time, but we actually felt that what he did was not that wrong, and we glad to say that he has been the conviction has been overturned, but he still spent 2 years in prison. In this case, the suspicion from the U.S. authorities, in this case at the federal court, they thought that he was not pre-hedging, was front-running. So there was some conditions here that would not really totally satisfactory for the legal team. But in the end of the day, what he did in the market was pre-hedging and not front-running. Front-running is illegal, and in this case, the conviction was for front-running, but then he has finally cleared. But even though he suffered for a lot of years, spent 2 years in prison, and only now has cleared his name. So the thin line between pre-hedging and front-running is very, very important, but I'll leave you to lead into that. You have quite a lot of things there. We submitted 3 amicus briefs because we believe that what he did was not totally wrong, particularly in the activities in the market, and this is why we supported this. But anyway, I want to just and then you have some examples here on pre-hedging. So you can see that then when you receive the pack. But I just want to go then into just focus 2 or 3 things about settlement risk before we go and cover the exam experience. So settlement risk, as we saw that, just to tell you a little bit in terms of the amount of settlement risk, we are waiting for the figures of the BIS report. The figures of the daily turnover of the FX market have been published, but the full report will be in December, so by then we'll know the amount of the total amount of FX turnover which has no risk mitigation techniques. And because that happens because PVP is not available, it's not appropriate for certain transactions, or it's too expensive for some market participants. And I want to tell you a little bit about CLS. I'm sure you all heard of it. You probably have some of you as well. But of course, CLS is a very good system. It's widely recognized around the world as a good system, but it's only applicable in 18 currencies. CLS, as a company, was involved in the FX Code since the beginning, but for the same reason that the ISDA and CSA and the SWIFT are not explicitly mentioned in the code. CLS is not not mentioned specifically in the code, because again, CLS only settles 18 currencies, doesn't settle all the currencies in the world. So in order not to restrict that it's only 18 currencies that could be done via CLS, let's do PVP. If there are other alternative systems that use PVP, they are better than we go into the rest of the risk waterfall approach. And you just have there some information why CLS is not available. I'm bringing CLS here because, okay, as I mentioned SWIFT, as I mentioned ISDA, but also as well because they have a very, very nice report that was published in February this year that talks a little bit on some areas after the introduction of the risk waterfall, on some particular examples on how to eliminate settlement risk. So, of course, they have a system that allows elimination of settlement risk, but they also mention as well some other examples which are good as well for elimination of settlement risk. So I'll leave that with you, and this is what I wanted to talk about, settlement risk. Sorry, I think the batteries are going down. So you do have a few things there as well about the T+1 potential impact in FX, but I'll just leave you that information for you to read. Okay. So you do have some information here about stable coins. It has been discussed, particularly their usage on settlement, on payments. It has been discussed in the recent meeting of the Global FX Committee. I also leave you there with some information on potentially there could be some issues that will be discussed over the next coming years. I'm not sure if they're going to be covered, of course, in the next review of the code. We're still 2 years away, but there are some of these issues. This is public information. It was actually discussed, and you have the minutes of the recent meeting where this is discussed. And the same point as well, and we mentioned this briefly when we talked about reference rates, but also as well there was a discussion, there was a panel on in Singapore meeting about the benchmarks, about the trying to have some recognized benchmark providers to assist us on valuations rather than us having to do a transaction, a forward transaction or a swap or a derivative or another option, and go and trade and go in and trust the valuation of the provider of that person or the counterparty of that person. So there's still discussion a little bit in terms of some widely recognized platforms or systems to do the benchmark, and they are independent. They're not just from a central bank, and they don't refer only to a specific currency of the country. But anyway, just to leave you with that. So very, very quickly, I'll go here into the part of the exam, and this is what I want to show you. Let me just go ahead here. So we do have, and this is something that we have agreed with Sri Lanka Forex Association. Last year we did first round, and the idea here is to, for those of you that haven't taken the exam, for those of you to take it, and for those of you that have taken, to validate it, because okay, now the exam, now the content of the exam is updated to the new version of the code. So it's really an exam that covers the 55 principles of the code and the annexes and the foreword, and it's really, really an exam that can be taken anywhere. I would not advise you to take it on your mobile or on your iPad. Take it on the computer, but you can take it in the office, you can take it at home. It's just because the visibility of some of the parts of the exam in a mobile is not that great. But you can take anywhere. It's not supervised. So this is an exam where you have the possibility to take anywhere on a computer. It has another feature which is actually quite relevant. So 40 multiple choice questions, and you need to have 30 of them correct to have an overall pass level of 75. But the exam has a duration of 1 hour, but you have maximum 30 days to complete it. So you can go, if you get booked by the exam tomorrow, you can go into the exam and complete that 1 hour in portions. You do not need to take the exam within the following hour after you join. No. You can go in and see 5 minutes. Tomorrow is not a good example, it's Saturday, but of course, if the market gets busy, all you need is to close the window of the exam and come back later. But you can also go to the exam and check all the questions. The idea of this exam is really for you to train. If you train, look at what we've supplied today, the sample questions, all the material, the code itself, the illustrative examples, and train. If you go, for instance, into the exam and you see there the areas, if there are areas where you feel more comfortable, let's say that if you come from an operations department, maybe you go to confirmation and settlement first. That's not a problem. The exam comes on that order, but if you want, you can join and go to confirmation and settlement. And you can see the questions, you can see all the questions in the exam. All that you need to take care and really, really be very careful is do not waste that 1 hour. Only waste that 1 hour when you are ready to finish the exam. So if you want to do, let's say, on Monday, you get the exam, let's say, book tomorrow, as an example. On Monday, you go and do 10 minutes. You go and look at the exam. You go back to the questions. Use the bookmark function. Very, very important. Some questions are quick to answer. Some other questions require a little bit more thinking. If you have a challenge on that, or in particular areas of the exam that you're not that comfortable, mark them, bookmark them. Because when you go next time, 3 or 4 days later, and you access the exam, you'll have identification of the questions that you look into it, and what you should really do, and this is what I recommend. Go into the exam, look at the questions, and if you think that they are challenging, mark the areas, mark the question there, and point out on a paper next to it, or if you have the code next to it, oh, I need to look at better at this principle. Train. Go and read the code. Go and see the exercise. Oh, I remember that Rui did an exercise on this topic. Go and look into that and study. And this is really an exam for you to study. If a principle is not really clear at the first time, go and look at it again. But you have access to the questions. The questions will not change. From the moment you access the exam, the questions, the 40 questions are always the same. So you have a possibility to look into there, and the idea there is really, really go and study a little bit more. The way the exam is set up like that, not for you to fail. And we'll see, I mentioned to you this morning that we had, out of the 153, 146 persons passed at their first attempt. The idea here is that you need to train. But if you train, you're going to be perfectly okay. And this is why the exam is set up like that. It's not an exam for people to fail, but in order not to fail, and you will not fail for sure, just study a little bit the exam. Or study a little bit, sorry, the content of the code. And again, use the functionality. You will receive the terms and instructions on that. I'm always available as well if you need to clarify any doubts. And some of those tips are here, and we'll just go and cover them. For instance, of course, computer-based, not supervised, all in English, no calculation questions. Even if you're sitting next to your colleague, the questions are not the same, they are randomly selected. And then you go here, you can mark them for potential reviews. The exam has a validity of 1 year. This is why the ones that have done it last year, they are now doing that again. And whenever you finish the exam, hopefully all of you will receive a PDF, meaning that you passed it. And hopefully all of you will aim not to have 75, but to have either a merit or a distinction. In terms of, so really, really look well. You have 30 days. You receive the exam instruction on the first day, and we'll agree with Sri Lanka Forex Association when it's the first day. Look at the terms and conditions and look into that. The bookmark function is very, very important because it allows you to look at the questions and go back and study a little bit more and come back to the exam platform and feeling more comfortable that you will answer those questions correctly. In terms of the study, we gave a lot of tips around here today. Again, as I mentioned, those questions were not put on a randomly basis. They cover very, very important issues, not just for the exam, but also as well for the implementation of our daily roles. But look into some of these topics. Illustrative examples, very, very important. Not just the questions here, not just the sample questions that we'll provide. Also as well the glossary of terms. Look at those definitions. Study the questions that we provided. When you're answering the exam questions, do not consider your personal practices, which are surely top of the top. But also do not consider the practices of your entity, of your market, of your country, region. You are doing an exam on the practices that are covered by the FX Global Code. So do not consider also your local legislation. consider applicable law as it is detailed on the effects of a code with potential application in every jurisdiction. Agent and principal, very, very important. And we cover that, not just go to principal 8. Markup only for principal, pre-hedging only for principal. So do not study the principles in isolation. Most of them are linked. You remember we mentioned principle 35 about managing settlement risk, very connected with principle 50 about the settlement transactions or the settling of transactions to avoid increasing this risk. Definition of market participant. This is why we made those exercises at the beginning about market participant as an entity and about market participant as an individual. So look into that. Remember that market participants, 3 defined by the code: the entity or the firm, personnel, and senior management. They define senior management differently from the rest of the personnel because of the responsibility, higher responsibility that senior management have in implementing all these frameworks and to be the role model for the ethical and professional standards to the highest level that we want and that the code promotes. For the exam, think globally, not regionally, and always think about the part of judgment. Applying good market practices before trading is always better than remediation processes after trading. If we remediate, it's because we already have a problem. Let's try to avoid the problem. And this is why I mentioned earlier as well. Exercise your judgment. You already are professionals, market participants that promote the highest ethical and professional standards. If something is dubious, something is fishy, maybe don't go ahead and don't even consider it. It's better to take care of that and not consider that activity than having to remediate if there was a problem happening. And the final thing that I wanted to show to you is that the passing rate of candidates to the exam. You can see here that overall about 94% of candidates have passed this exam. This year is about 95%. I hope you all take this year and you all improve this relevant. It's not a difficult exam, but really my advice is train. Look at the codes. Look at what we did today, the exercises, the sample questions. But you need to train. If you train, you're going to be okay. Okay? So thank you, all of you, for your patience, for your understanding, for your participation. Even if some tables didn't raise their hand, that's okay. It's Friday. You're saving all your energies for tomorrow. So thank you again, and thank you, Dita, and thank you, Trimali, for you. And hope to see you all tomorrow. Thank you. Thank you. So this is just the exam, the exam platform that you all received the login for that. Oops.
Good evening, ladies and gentlemen. We have come to the end of yet another successful training program on BIS FX Global Code organized by the Sri Lanka Forex Association. With the updated Global Code, we believe our members should be aligned with the global standards, which will strengthen the professionalism, transparency, and integrity of the market. And of course, I take this opportunity to appreciate and pay our gesture to a few of the key parties who made this workshop possible. And first and foremost, to our resource person, Rui Correia, the Chief Executive Officer of ACI Financial Markets Association and also the Chair of the ACI FMA Board of Education. Thank you, Rui, for taking your time off from your busy schedule to be with us and to share your knowledge with our community. And of course, a very big thank you to all the heads of treasuries and the brokering institutions for nominating the participants for yesterday's and today's program. And of course, the response we received was quite overwhelming, which shows that the importance and timely importance of this workshop. And of course, a very big thank you to the Hilton Colombo for all the arrangements made for this. And last but not least, a very big thank you to all the participants. Without you, this program would have been a success. And I hope this workshop was definitely very insightful and informative. And before we wrap up, Udita, please join me in giving this small token of appreciation to Rui for his support, as always, for SLFA throughout the past. With that, we wrap up this program, and we look forward to seeing members tomorrow at the Forex Board 2025. Thank you, and have a very pleasant rest of the evening.